product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We have got a lot to talk about. Live from New York City this morning. Good morning. Equity futures look like this, down 0.4% on the S&P. On the Nasdaq 100, down 0.5%. One stock to watch right now, it's Walmart. A little bit later, Alphabet and Microsoft. Let's do the Walmart story. We're negative. We're down by more than 9% right now, and it bleeds into the likes of Target, down by 5 percentage points. Is this an execution problem or a sign of consumer weakness? Maybe a little bit of both, but quite clearly the product mix for some of these companies continues to shift in a way that they just cannot forecast and are failing to anticipate. That means it's not a revenue story, it's a margin story. And that's why we've got to cut the profit outlook for the likes of Walmart. Once again, for those of you that say, yes, we've been talking about this for ages, it must be well priced, well, clearly it's not. We're down 9% on Walmart, Target down 5%. I want to talk about the bond market too, 2s, 10s and 30s. Are we starting to see a sign of weakness in the labour market based on claims of the last 3 weeks? Possibly. We'll have to keep a look at that. Lisa Shallett of Morgan Stanley Wealth Management, though, pushes back. Those 3 weeks of claims are not enough to stop this Federal Reserve. That 2-day meeting begins today with yields in. Just a basis point on a 2-year, Tom, at 3%. Yields in 4 basis points on a 10-year. 275, let's call it 276. A spread between the two, that inversion pushing 25 basis points this morning.
Where's that inversion going to be in a year if you look at Anna Wong's new publication? John, moments ago, Anna Wong of Bloomberg Economics frames out an upper range of 5%. That's the first time I've seen that. She shifts 100 basis points on her upper range from 4% to 5%. John, what does your data screen look like with a 4.65, 4.75 setting for the Fed a year and a half out?
You could see an ugly picture where the front end has to shift higher.
Stunning.
And the hopes and dreams about growth down the road just get absolutely hammered, Tom.
Stunning. Absolutely stunning. Are you done, or you got foreign exchange?
I am done unless you want to bring up
John, let's talk about Euro Swissy quickly. John, I think Euro Swissy speaks volumes today of the instability on the continent.
Euro weakness. If we've got an agreement, good news that they can agree on something. Here's the bad news. They've agreed to limit gas consumption. So what have they done? They've basically reduced potential growth. And I think the Russians were going to do that for them anyway, Tom, and that was the problem. Russian gas is coming into Europe at a reduced capacity through Nord Stream 1. It's set to clip lower once again. Prices are heading in the wrong direction. And Tom, for me, this is the problem the ECB's got. Can have a situation where they reduce consumption, but prices still remain elevated because the Russians are going to reduce supply. What are you going to do? You're going to temper growth and at the same time fail to bring down gas prices? Could get even messier in Europe. So if you're asking me for a prediction on September and this ECB, I haven't got one because I don't know what September looks like.
Futures -18 and deteriorating. We welcome all of you on Bloomberg Radio and Bloomberg Television. 3M out, Minnesota Mining out right now, and they take down sales from positive statistics down to outright negative statistics of negative 0.5% down to negative 2.5% as well. That is a precursor for a Rip Up the Script conversation with William Lee. He's chief economist at Milken Institute and so competent on not only international economics in the Pacific Rim, but also a student of our domestic economy. Bill Lee, on the break into this, we were talking about this recession. You say for America, it's different. This is a recession where workers will benefit and the fancy people may not.
Well, Tom, given the shortage that we have in warehouse workers, service workers, waiters, and nurses, it's very clear that the wage increases are telling everyone we need more of them. And even if the economy turns down, I think the Amazons of the world will continue to hire blue-collar workers. So this will be the first white-collar recession in the longest history of the United States. So I think if we were to have a recession that spreads into the labor market, we're going to find that the regular workers, the Joe Sixpacks out there will be safer than the computer programmers and middle managers.
I don't understand the distinction for so many Americans, Bill Lee, of an outright NBER recession and something that you and I used to call a growth recession. I used to feel pretty bad in a growth recession, right?
When things slow down, income slow down, and spending slows down. The reason why is because you feel crummy. I mean, you don't have enough money to spend, and especially given the high inflation that we have now, stagflation really induces and is a precondition for a growth recession. And you're right, you don't feel good in a stagflationary environment.
Bill, how quickly could we see labor really turn?
You know, that is a great question because right now, Chair Powell's been saying we have a really tight labor market because we have so many vacancies out there. But if you look at the pace of hiring, the firms are not hiring at a faster pace, even though they're raising wages. So what I think is that there's really a microeconomic disequilibrium going on. The dislocation in the labor market is one where firms are looking for better workers, and workers are looking for better jobs because they feel that they have now retrained themselves and qualified for better jobs and higher pay. So the only way to solve this problem is with higher productivity, and the only way to do that is to have the adequate investment, and we're not going to see that with the kind of results that Tom just talked about with the shortfall in earnings that companies are experiencing.
So just to parse that out a little bit more, are you basically saying that this is going to right itself in the near term and then you'll start to see a creeping up in the unemployment rate? How does this sort of change the trajectory as people talk about a technical recession but not a real one because the employment picture hasn't been participating to date?
I think as we see the 2 quarters of negative GDP growth in the bag, we're going to see the weakness spread into the broader economy, and then the firms will react by, as I said, hiring more of the blue-collar workers because they still need them, but they're going to try to employ technology to roll back the advanced workers, and you'll see the unemployment start to affect that segment of the labor market, which is service sector is a very large segment of the labor market.
Bill, Bruce Kasman was on yesterday with J.P. Morgan. It's a small bank. You may be familiar with it. And Dr. Lee, Dr. Kasman made very clear it's exports to the rescue as possibly the Pacific Rim opens up. Are you optimistic that we will get export growth off the Pacific Rim, or is that something that awaits COVID and the reopening of China?
Well, Tom, that's a loaded question because Bruce is a classmate of mine at Columbia, and we go back a long ways. And as much as I admire Bruce's analytic capabilities, I think he's missed it there. The exports to the Pacific Rim are going to be limited because the growth from the Pacific Rim, namely China, is going to be very limited. China is now suffering from enormous amount of domestic dislocation with their COVID policies and their shutdowns and structural policies with a huge rise in youth unemployment and the depression people are in and affecting consumer spending. So the only source of demand that may come from the Pacific Rim would be the outer rim, the ASEAN countries.
Bill, just because this is so important, can a totalitarian regime, particularly one going into a party fest in November, can they unilaterally affect a slowdown or depression?
Well, they're trying to goose up the economy like crazy. They're issuing a lot of debt. They're trying to do the same old playbook, which is infrastructure spending. Unfortunately, the private sector is what's collapsing, and given that property market is no longer a real store of wealth for people are not spending. So as far as I can see, and as far as the eye can see, China is going to take a while to recover back from a 3-handle and 2-handle on its growth rates.
Bill, to tie a bow on all of this, yesterday we had two guests on, Ed Yardeni, followed by Nouriel Roubini. Ed Yardeni said we'd seen the bottom in the stock market. Things were looking up. The U.S. economy was resilient. The world wasn't so bad. And then Nouriel Roubini came on and said it could be worse than the 1970s. We're facing stagflation. We're facing all sorts of terrible things. Where do you stand?
Congratulations on your range of guests. I'm going to have to stick it in the middle. I agree that the markets seem to be sniffing out a bottom because they're seeing the bottom of the recession that's yet to come. They may not estimate its magnitude, but they are seeing the bottom and they're planning for the recovery. As far as the rest of us are concerned, high prices are still killing us. The inflation is likely going to stick longer, and consumer depression is going to likely hang on for quite a while.
Bill Lee, awesome to catch up. As always, buddy, from the Milken Institute, as we look ahead for a Federal Reserve, a 2-day meeting begins today. Alan Ruskin of Deutsche Bank asked a really important question, Tom. Not just about where we'll peak, but how long we'll stay at that peak in Fed funds. And I don't hear that question asked often enough. He looked back at the last 3 Fed tightening cycles, and he said the time spent at peak was 7 months in 2000, 12 months in 06-07, and 6 months in 2018-19. And he said this present cycle raises the prospect of staying at peak Fed funds a whole lot longer, something that maybe we haven't talked about enough.
It's a huge, huge issue, and that's why the 1947 to 1952 analog to events there really doesn't fit, because they cleared the markets back then very rapidly, and disinflation was upon us quickly. And it's really interesting that persistency, the sum of inflation, if you will, John, the persistency of inflation. Again, John, I'm going to go to, and I get a lot of hate mail. I mean, John, I know you get all the love notes. I get the hate mail.
Bramo gets the love notes, not me.
But the hate mail I'm getting is basically inflation's going to come down. Well, come down to what? 7%? 5%? At 5%, is that acceptable? At 5%, is that harmful to the middle class of America with no wage gains? These are really important questions.
They're hoping it comes down to 4 by year end, Lisa.
By year end now? Year end is like tomorrow.
Year end, I'm not sure how we can get this down to 4 by year end without doing some real damage in this economy.
Alan Ruskin's point is very well taken, especially because this feeds into the market's expectation currently being baked in that the Fed's going to start cutting rates next year, which means that the moment that they spend at peak rates is basically a blink of the eye, right? I mean, they can just do that quickly and then go right back down. But how quickly do we get this transmission mechanism, especially if we don't see a weakening in the labor market, which is the reason why that might be the linchpin of both the Fed's actions as well as how deep and how difficult this recession will be.
How many times have you heard an equity bull turn around and say, Chairman Powell has proven that he can pivot, and he'll pivot again? Chairman Powell's proven he's made the mistakes that are bad enough, which has led him to need to pivot eventually. But ultimately, there's some damage done along the way.
I just love that we're at the place where all equity strategists are rate strategists, and rate strategists
always the way.
Are equity strategists. And right now, my head's spinning.
My head's spinning too. Futures, down 0.5% on the S&P. I know you're dialed in, Tom. You can tell. The Nasdaq down 5 or 6 tenths of 1%.
Can you make the Tang stronger?
Yield's down 4 basis points. 276 on 10.
There's no sugar in it.
From New York.
There's no sugar in the Tang.
This is Bloomberg.
Please. Northwestern, please.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Union is preparing for the possibility of a full cut-off of Russian energy supplies. EU nations have agreed today to cut their natural gas use by 15% through next winter. The rapid pace of the agreement reflects the dwindling gas flows from Russia. Supplies through the key Nord Stream 1 pipeline are set to drop to around 20% of capacity. Now, former President Donald Trump returns to Washington today for the first time since leaving office. He will make a speech to a think tank that is working on an agenda for a possible second term. An aide says he will focus on public safety. His visit to the capital comes as the January the 6th committee has been detailing his attempts to remain in power and his refusal to call off a violent mob of his supporters. In China, the economic recovery is gaining momentum this month. Business activities resumed and confidence also improved despite disruptions from COVID outbreaks across the country. That is the outlook based on Bloomberg's aggregated index of 8 early indicators for this month. General Motors posted second quarter profit that was weaker than expected. Semiconductor shortages limited vehicle production. Still, GM maintained its guidance for the full year. That reflects robust demand for its highest priced SUVs and trucks, and it signals optimism that GM can get the chips it needs. UBS has reported weaker than expected profit in the second quarter. The market sell-off kept the Swiss bank's wealthy clients on the sidelines, and institutional investors withdrew funds. Investment banking results also trailed expectations. UBS confirmed plans to buy back $5 billion in shares. That's CM. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The top concern for Europe is indeed cutting off completely from the gas supplies. First, it will increase gas prices. Secondly, it will render a couple of industries as very inefficient. And with that, generating further inflation, making inflation stubborn, which is the real danger.
Ralph Hammers there, the UBS CEO, live from New York City this morning. Good morning. Futures negative 0.4 on the S&P. On the Nasdaq 100, we're down 0.5%. Pain in Europe, euro-dollar, negative 0.7%. Euro weakness, the story through G10. Euro-dollar 101.48. 10 years since President Draghi was in London, Tom, and mentioned those few words, whatever it takes.
Yeah, the few words, and then there was a certitude of the ECB, John, really a distinctive feature of that bank, and that they would come out with confidence about an 18-month view. There'd be this, you'd see a headline with 2023 in it and go, really? You're going to go out there? That's all been blown up, hasn't it?
Easy to offer forward guidance, Tom, when inflation is low.
Yeah.
You just say max dovish for a long, long time. Look at these forecasts.
Yeah. I really want to emphasize that, folks, this morning the data screen is extraordinary. We're watching the earnings. 3M actually up on a spinoff, but organic sales adjustments are really tangible within industrial America as we go to what we're going to see this afternoon from Microsoft in big tech. Right now, on something, well, we've noticed ruble. Ruble is strengthened, most strong. John, strongest currency in the world, right?
Year to date,
I think
Tom.
so, yeah.
In EM.
Yeah, no question about it. But in the commodity space, it was an absolute layup. Kona Heck was on here recently saying, be careful. And she has been dead on about a round trip in wheat is one example. Kona, is the bull market in commodities, is it over?
Well, if you look at the price action, they are back to where they were before the Ukraine invasion took place. So in that regard, yes, we have wiped out all the gains we saw in the last 6 months, if you like. I personally think that it might be a little bit oversold from here, certainly for grains and agricultural commodities. Prices are not cheap as they were maybe 2 years ago, but cheap with respect to some of the supply side risks we still potentially face. We saw the grains deal. It's not going to be huge. There's still a lot of tonnage that needs to come out of Ukraine. So what we're talking about is actually quite small, relatively speaking. And there's a lot of weather risk still ahead of us in the U.S. Corn Belt.
Fold it into hydrocarbons. I mean, you're not doing oil like some of our other guests, but take an ED&F man oil call, Brent crude call, and fold that across commodities.
So crude is about over 100, 106, let's say, for Brent. And I think, you know what? I think we're literally in a tug of war right now. We've got the global macro, we've got the recessionary fears, we have demand destruction. And on the other side, we have immense supply risks, whether it's OPEC getting close to capacity, spare capacity, or whether it's outages in Libya, whether the fact that Russia could anytime, cut even further, and also the gas supplies. For all the demand destruction we're losing from the economic instability and the recessionary fears, we potentially have the oil disruptions gas disruptions could lead to substitution demand coming into oil products. And so then you lose some of that loss in demand. So it's pretty well balanced, I'd say. I think both arguments are very strong. I think when it comes to below $100, I think it might be a little bit too cheap. I think where we are now kind of balances both the risks of demand destruction and supply side risks. So I think we're kind of where we should be, I guess. And now the momentum has to take its course, whether today, tomorrow's interest rate hike, what that does to the macro risk. If the markets think that that's too much, then clearly there'll be another bout of selling in commodities. But if you look at how the hedge funds have been, the speculators have been coming out of commodities, it feels like that big exodus is now beginning to stabilize, and maybe they've cleaned out a lot of their positioning now.
Kona, there's a financialization story of commodities, and then there's the real story of commodities, which is being borne out right now in Europe. And I want to focus in on what you had been touching on, which is the gas prices and the gas shortage, especially if Russia continues limiting the supplies of gas going through Nord Stream 1. How much are you looking at prices that kind of equalize around a certain level near where they are now versus continue to surge? Because even though we are hearing from the European Union that they're going to cut back 15% of demand going into the winter, you're already hearing about carve-outs. You're already hearing about countries that are preparing to use a little bit more than that, especially if prices stabilize.
No, absolutely. And I think we're okay now. Gas storages are in the EU are ramping up to the desirable 80-90% level, which is what they want to be by around about November. So we're on track for that. But look what happened this summer. We had an extraordinary heat wave in the EU. What if we have an extraordinary harsh winter in the EU, December, January? That means, even at 80%, we're not comfortable. And then there's always the risk of what will Russia do to its supplies. Gazprom, I'm understanding, is just suddenly increase the pressure there. That could lead to sudden outages. It's highly volatile, highly risky, and I know that in the EU governments are doing the right thing by trying to rationalize everything they can in terms of cutting back. But it's not going to be easy, and we cannot forecast what's going to happen on the weather. If it's going to be extremely winter and therefore very, very energy intensive, I think all bets are off again.
I don't think anyone can forecast this. Kona, thank you. Kona Hack there of ED and F-Man. Lisa, what a tricky moment. I mean, I find myself saying this so many times about Europe. You wake up this morning, they come together and come to some kind of an agreement to reduce gas use. How that actually plays out in practice over the next few months remains to be seen. At the same time, Gazprom, Russia, essentially indicating that the capacity use of that Nord Stream 1 pipeline is going to go down from 40% down to 20%. And there's still many people out there who believe it could go down to 0 going into winter.
And at a certain point, it almost doesn't matter. I mean, it matters, but the fact that they're playing this game with Europe to say, we're going to turn it back on. Oh, wait, maybe not, because there's a turbine somewhere over in that needs to be refurbished. How much is this going to cause prices to rise anyway? And how much does the 15% cut that they're talking about highlight the concern about the danger more than the remedy, which may not be the whole 15% given some of the carve-outs?
It's going to hit growth, it'll hit GDP. You throw it into a pot this morning, stir it up, what you get? You get a week of Euro, Tom. Euro dollar 101.49 and negative 7 cents of 1%.
I agree on Euro. I'd watch that very carefully, and it moves against a static yen as well. But DXY moments ago, John, out over 107. You really wonder in the next 48 hours, the tension into the Fed meeting. The Fed meeting is when? Tomorrow?
It is tomorrow, Tom.
Oh, thank you.
We're doing a special program, which you will be a part of.
Really?
Tomorrow afternoon. I wonder if this Fed acknowledges some of the weakness that's starting to emerge. And what would happen if they did start to acknowledge that? Because that would be the problem for this Federal Reserve. This is always the issue with central bankers.
Yeah, I mean, yeah.
To some extent, they have to lie. Because if you acknowledge the weakness, then the market picks up on that and starts to bring forward this idea that they pause.
John,
harsh how? You telling me central bankers tell the truth all the time?
No. Cardinal rule is institutional officers, they have to lie to maintain control.
Hold on a second. Lying is one thing. Trying to give accurate forward guidance. Trying to give accurate forward guidance at a time when financial conditions are loosening rather than tightening, that is a different story. So how do they get those financial conditions to tighten even while not lying?
When Jerome Powell was in graduate school, he was watching Animal House. Remain calm, okay? That's their mantra.
Futures down a third of 1%.
John,
Why do we run out of time when things start getting spicy? Yields in 4 basis points, 276. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The market is waiting to see clear signs of a recession.
You can argue about whether or not it's a recession technically or whether or not it's a slowdown, but it's definitely a loss of momentum.
We're just still concerned for those confluence of risks.
The Fed needs to have a policy stance, a trajectory on inflation, and dynamics on growth that gives them comfort.
The financial markets are not going to be surprised by 75 basis points.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 0.4%. TK. It's all about earnings today.
It's all about earnings. Coca-Cola, John, with a headline I just saw. I've never, ever seen this before. Coca-Cola with a 9% currency headwind. John, these are extraordinary times.
If in doubt, Tom, blame the dollar. Is that the theme for this quarter?
I mean, 4% is sort of the theme here. We're going to get to Julian Emmanuel with our conversation of the day on all this. But, John, I'll tell you, it's so illuminating to see how each company is struggling with this original post-pandemic economy.
Struggling to execute and struggling to land the company at the right spot at the right time with the right inventory. And Walmart's struggling to do that, Tom. That stock's down 9% this morning.
Now, you nailed it. You called it the mix there, John, and it's a product mix, which they alluded to weeks ago. I give Walmart credit. They've been out front on warning people. McDonald's out right now, John. I don't know what to make of it. I can't read that. I can't read like you can read, but comp sales, 9.7%. That's a lot of cheeseburgers.
You can't read like I can read. That's the best coverage of McDonald's I've ever heard, though, Tom. That's a lot of cheeseburgers. Probably true. Probably is a lot of cheeseburgers.
We need to do some research there. Number 2 value meal, we can do that.
Thank you, Tom. I want to pick up on the product mix story. It's a revenue story, except it's not. It's about how they're spending, what they're spending on, Lisa, which makes it a margin story when the product mix starts to change. They can't anticipate how quickly this is going to change. We've seen it repeatedly from Target to Walmart, name your retailer. They're all failing to forecast how quickly some of this is moving?
The big box stores have often that grocery component. That is where more of the dollars are going. That is a smaller margin business. And then they have all of these clothes that they ordered for when people were staying at home doing yoga. And all of a sudden, people are now not buying as many clothes. They've already bought the clothes to go back to work when they go back to the office. And they're dealing with this glut that they have to discount. It becomes a problem, and it is a persistent one, and we're seeing that show up.
Execution problem for the company, or
Connection
consumer
lost.
problem for all of us, or a bit of both?
Well, right now what we're seeing from McDonald's, what we're seeing from Coca-Cola is not all companies are suffering in the same kind of way. That said, the discretion that people are showing with respect to going to food, going to gas, not going to other areas is something that we're starting to see show up in a lot of different metrics.
So looking ahead to earnings from Alphabet and Microsoft a little bit later. Lisa's going to guide you through the day ahead in a moment. I'll guide you through the markets briefly. We're down 1/3 of 1% on the S&P. On the NASDAQ 100, we're down 1/2 of 1%. Look forward to more earnings coverage with Tom Keene.
We do. Google.
I can't wait. Yields down 3 or 4 basis points. I can't do, Tom, I can do the Alphabet thing. I can't do the Meta thing.
Thank you.
I can't do the Meta thing.
I
Down
never
4
forgave
basis
Jerry
points.
Tsai for Primerica. It was always and forever American can.
Your yield on a 10-year, 275.94. And Lisa, I don't know where to start in Europe. Euro dollar 101.47, a weaker euro.
And I will just say, John, I think we do Meta every morning. Today, what it really is about Europe and what's going on with the energy ministers who are holding a meeting in Brussels to discuss energy security, this plan to cut energy gas use, I should say, by 15% through the winter, how they get member states to participate in that. You are seeing gas prices surge back to levels that we're seeing highest levels going back to 2020 at the peak of the pandemic. How do we get them to reduce the use substantially, especially because you cannot predict the weather, and especially because if you reduce the price, then people can consume more. It is head-spinning. It is an incredibly difficult situation that Europe is in. Economic data today ahead of the Fed's decision tomorrow. We get U.S. house price index for the month of May. We also get consumer confidence data from the July Consumer Confidence Board. How much do we see a differential here from the University of Michigan survey that we know the Fed tracks? Do you see some sort of deterioration here as people start to look at some of that higher inflation reads that we've been talking about? And today, Microsoft and Alphabet both reporting after the bell. We've been talking about this throughout the day. It's about advertising. It's about the consumer. Yes, it's also about the cloud. But John, what happens to the index if big tech disappoints? Has it been priced in? And that is what really is the big question hanging over this week.
We've got the perfect guest for that, Julian Emanuel, in the studio here in New York, a good friend of ours, the chief equity and a quantitative strategist at Evercore ISI. Julian, the big tech players have pulled back on hiring intentions. Do you expect some of that to show up in their guidance?
No doubt. And I think when you think about the evolution of markets over the last couple of weeks, we've actually gone from the pulling back from hiring to where now corporate America is announcing layoffs. Automotive, social media, we're going to see a lot more of that, and that's really why bond yields are back near multi-month lows.
On a daily basis, Julian Emanuel, your morning note is the most valuable 3 paragraphs I read. You quantify 24% of S&P earnings in. You go through all the math. We don't need to deal with that right now. What it means is corporations are adjusting. Given Ed Hyman's growth recession-y kind of feel and the micro-analysis you're acclaimed for, how will corporations adjust over the next quarter?
Well, they're going to have no choice because, you know, you've got every single thing coming at you. You've got the need to reshore, the need to stock because your supply chains have been broken and they're no longer dependable. But at the same time, you've also got this fact that, you know, the world is changing. Economic volatility is so much higher now than it was the last 30 years that all of these factors are really very different. I think what it ends up meaning is that at the stock level, valuations continue to ratchet lower. But again, corporate America has always found ways of, you know, squeezing profit and figuring out how to transform itself. We don't think it's different this time.
Julian, that's nice for companies that can actually do that. Yet every stock analyst that we speak to, and I see John laughing at me saying it's nice, every stock analyst we speak to is becoming a rate analyst and saying it's all about the Fed, whether they torpedo the overall economy or not. And as much as companies can adjust, they cannot adjust in the face of Volcker. How much does the fate of the S&P really depend entirely on how far the Fed has to go versus some of these adjustments that each company can make?
Well, it's really at this point means a lot. We're at a crossroads. If you look at it, the average recession bear market loses 41%. The average non-recession bear market, you could argue we've already done that. But the fact is that we have not seen any indication other than the Fed is really concentrating on the single mandate of the dual mandate, which is inflation. And from our point of view, you've already started to see signs of it turning down along with the economy weakening. And we wonder whether in a reverse logic of the last 40 years, the Fed might step back and say, okay, we have more ammunition to hike if we need to later, knowing that cutting rates next year is the single thing that causes potential inflation expectations to become de-anchored.
Julian, when you sit around the table with Ed Hyman and he's expecting bad news, do you sit there and think then that bad news is bad news for your market?
Again, that's what's really tricky about this current juncture, because you don't see the Fed reacting to bad news because inflation does not allow them right now to react to bad news. We do think that looking at the next couple of months, that dynamic could change.
Julian, I want to just clarify something that you said. A lot of people think that if the Fed doesn't go far now, it's going to lead to inflation expectations becoming de-anchored. You just said the opposite, that if the Fed goes too far now, pauses, and then cuts rates, that's what's going to cause inflation to become unanchored. How much pushback do you get to that? Where do you get that idea?
That goes back to the 1970s, something we call the Burns blunder. If you look back, the 1974-75, you had inflation really raging, structural inflation, arguably somewhat different this time. And Chair Burns cut rates in the middle of that surge to fight a recession, and that caused literally another decade of inflation to become well anchored. Look, part of the dynamic in markets is that we've all been Pavlovian trained to expect stocks to rally when the Fed cuts rates. To the extent that we take that away, you're actually doing a service and allowing to see the fundamentals emerge.
What happened to Pavlov? He was chief market strategist at J.P. Morgan. Was that? Do I remember that? Or maybe it was DLJ. I can't remember. John Pavlov was just outstanding.
Julian, thank you. Julian Manuel of Evercore ISI. That conversation got derailed there, Tom.
At the end. I can't say enough, John, about the value of Emmanuel's note in the morning, John.
I think Julian's great.
Of lining up the dynamic. It's a crazy season, as McDonald's just stated, and they've got huge challenges ahead. But we got to be very clear, amid the gloom here, like of a Walmart, there's some very constructive stories around people that aren't, involved with revenue from the middle class.
They speak to a bigger picture, though, and Walmart is not revenue just from the middle class, Tom. That's a bigger picture about how much more people are having to spend on gas and on food.
Oh, yeah,
how much
absolutely.
less they can spend
their
on
unit count's
other
up.
Goods.
Their unit count is up.
Yes, the revenue line's decent, Tom, but the margin line isn't. And that's because of the product mix ultimately shifting. I just don't know why we're surprised by this. And seemingly we are, because the stock's down 9 or 10%. And I've asked that question repeatedly, Tom, about the retailers. We're told a lot of times that this is priced, and then the bad news comes out, and it's not.
The way it is. That's always the way it is.
Just not.
We're
I wonder
just
what that
failing
means
at our job.
for the tech players a little bit later, Lisa, with Alphabet and Microsoft on deck.
Especially because a lot of the headwinds that Walmart was talking about are lasting. To me, the fact that they actually brought down their forecasted revenue for 2023 tells you so much. It's not just for the rest of the year. They see this persisting. How much is it a hangover of the supplies that they have in the inventories versus persistent headwinds in where they're going to get those margins and which products are going to be popular?
What was that line you used when Julian threw a little bit of good news at you? That's nice. That's nice.
Well, that's all you can get out of Brambo.
Julian's crying in there.
Oh, yeah, I'm sure he's crying. No, he was brilliant.
Beautiful.
He had such good comments.
That's
I loved
nice.
hearing it.
That's nice.
No.
But let me tell you something. Futures are down 0.4%. from New York. That's nice. This is
nice.
Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Union has agreed to reduce natural gas use by 15% through next winter. That comes as a prospect of a full cut-off from Russia's supplies grows increasingly likely. Energy ministers meeting in Brussels gave the green light to a proposal to voluntarily cut their gas usage over the next few months. Now, the British economy was in focus in the first head-to-head debate between Liz Truss and Rishi Sunak. The two are battling to replace Boris Johnson as the Prime Minister. Sunak claimed that Truss's planned tax cuts would increase inflation and interest rates. However, Truss said that Sunak's plans would drive the economy into recession. Harvard is urging the U.S. Supreme Court to preserve affirmative action in college admissions. The university filed its brief in one of the most highly anticipated upcoming cases. Harvard argued that affirmative action is necessary to ensure a diverse student body. A group opposed to racial preferences has sued both Harvard and the University of North Carolina. United Parcel Service has reported second quarter profit and revenue that beat expectations. The package delivery service also reaffirmed its outlook for the full year. UPS has increased prices focused on its most lucrative customers and squeezed out efficiencies, even though package volumes cooled from last year. Shares of 3M are higher today. The company announced plans to spin off its healthcare business and will retain a 20% stake. Meanwhile, the new 3M will remain focused on material science. It has cut off its profit outlook for the full year. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Everyone's looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
You're going to see parts of the corporate sector going bust. You'll see the parts of the shadow banking system going bust. You'll see the household sector that is partly fragile going in trouble. You'll see some sovereign going in trouble. Yeah, the trigger for the financial distress is going to be a recession, and recession is not mild, shallow, but it's going to be severe and protracted.
After that, I'll have what Tom's having. How strong is that tank this morning, TK?
It was something yesterday, and as Lisa brilliantly said, going from Yardeni to Rubini, that's how we invented this show. That's what it's about.
Futures down 0.4 on the S&P. On the Nasdaq, we're down 0.5%. Here's a picture of the bond market for you. Yields come in 4 basis points. 10-year 275.58. Euro showing so much weakness. Euro dollar negative 0.8%. Back to a 101 handle, and only just. I'll talk about it a little bit more a little bit later.
Yeah, John, I think this is really important. I mean, there's a weight to euro, but I don't think what we've talked enough about here is, once again, German yields out front of the U.S. move. I'm sorry, there's a compression here of developed country yield curves.
And look at gas prices in Europe right now. They're heading
through February 24th.
We don't know what the supply from Russia is going to look like. We do know the Europeans are going to try and cut back on consumption.
Right.
So ultimately, we can conclude growth has got to adjust. It's got to come lower. That's why you see a weaker euro, Tom. That's why you see German yields come back in.
One thing certain, and particularly folks in the United Kingdom love fest between Truss and Sunak, they're younger. They are not in America. We have a president who, if he ran a second time, would be in the vicinity of 82, and former President Trump would be in the vicinity of 80, somewhere out there in a second term. Joe Matthew understands they're older as he is younger, and we look at younger Republican candidates right now. Joe, it's something we don't talk about enough. In the heat of August, it's going to be a backstory to the midterms as well. How do the Republican candidates, all 47 of them, jockey around the former president?
Well, they're waiting for starters here to see what the field is going to look like. But the more we see challenging polling data surrounding Donald Trump, you might see more potential candidates feel emboldened, like Ron DeSantis. Is he really going to wait forever to hear from Donald Trump with an approval rating in the low 40s? That's exactly where the former president stands as he arrives back in Washington today. A speech set for 3 o'clock in the afternoon, Washington time, his big return. But there's another guy I'm watching, and that's Mike Pence. He was supposed to talk last night. Didn't get his plane in time because of the severe weather, but he will be speaking at a separate event this morning in Washington. You know what the Trump Act is already. I mean, we hear his speech at once a week, every couple weeks there's a rally, and he's been very consistent. What's the Pence Act going to be? Will it be more than policy, and will he call out his former boss? We're going to find out in a couple hours.
Joe, you once turned to me over a beverage of your choice at the St. Regis in Washington and said, Tom, you don't understand. This city's all about money. Thank you. Can the Republican candidates raise money while they await the former president?
Yeah, that's a lot of cheeseburgers, to quote you from earlier. But yes, I guess you can certainly start raising money here. Ron DeSantis certainly is, and you see a lot of folks, kicking out the emails and so forth. But when you actually announce your candidacy, that's what changes the rules. That's why a lot of folks are pushing Donald Trump to make a decision here. Well, maybe Democrats are, but he would only stand to benefit by waiting. His triggering federal election laws changes the whole dynamic when it comes to fundraising. He's sitting on $103 million right now in his political action committee. He would lose control of that cash if he announced today. It would be the same for all the others.
Joe, when we take a look at the economic issues facing the United States right now, a lot of people are looking at some of the broad-based partisan messaging. I want to know how the Fed is going to play a role in some of the partisan discussions, given that right now the Fed has a chance at torpedoing growth, causing unemployment to rise. Will this become the whipping post, or will this become something that is sort of the neutral player that's doing what needs to happen in order to curtail inflation?
Well, it's certainly in the center of the conversation already. The Republican line is, the Fed was too late, but we're glad they're at it now and we support what's going on. The White House simply defers to the Fed, which puts it in a bit of an awkward situation, right? The White House saying we're doing everything we can to fight inflation. But of course, if you want to know more about that, call Jay Powell at the Federal Reserve. We will defer to an independent Fed. So I think it depends on what party you're talking about here and exactly where we end up in the fall. Lisa, the Fed could look heroic if they pull off a soft landing, if we start to see the tightening ease back a little bit, and that would coincide right in time with the midterms.
Joe, appreciate your time as always, buddy. Joe Matthew there, down in Washington, D.C., pushing ahead to the midterms. I can tell you ahead of the midterms, gas prices still falling. Lisa, every single day since the middle of June, going in the right direction for this administration. I'd argue maybe not down enough, but moving in the right direction.
And it's really important that they continue to do so, because this administration has pinned some of their entire message on bringing down gas prices, which is a little bit perilous, as a number of analysts have pointed out, because there are other extenuating circumstances that could cause gas prices to rise that are out of their control. So how much is this going to be a message that sticks with gas prices continuing to go lower?
Pushing ahead to the Federal Reserve tomorrow. That meeting starts today. We'll have special coverage for you. Great lineup, TK. Looking forward to catching up with Mohammed Al-Arian right after that decision at 2 p.m. Eastern Time.
It's a stellar group we're going to have, John, on the meeting, and of course the press conference. I believe our Michael McKee to be there as well. John, in the heat of this earnings season, can we note that McDonald's is absolutely cratered off of its highs near the beginning of the year? It's down 7%. I mean, the resiliency of their model. John, I was looking at Walmart earlier with a 3%. They make 3 cents on the dollar at Walmart. Even at the EBITDA lineup, the income statement, they only make 6 cents on the dollar. McDonald's makes 31 cents on the dollar in franchising. John, these companies aren't comparable.
I'm not trying to compare them.
No, but a lot of people are. A lot of people bundle them in. Oh, yeah, absolutely. They bundle them in as consumer companies. We're selling cheeseburgers. We make jokes about a number 2 value meal. It is a profit machine compared to the struggle at Walmart.
Well, they've got a problem with the product mix right now and the shifting preferences of consumers coming out of the pandemic, and that cycle is moving really fast. Walmart's down by 9.5%. I would throw Target in there into the same bucket, facing the same challenge, and we're going to see the results of that, Lisa, in the middle of August. And I just wonder if Walmart's come out ahead of the middle of August before they report, whether we hear from the others too.
Yeah, downgrading yet again. How many times do they have to downgrade their expectations going forward? Costco also, all the big box retailers. How do we get a sense of whether this is an idiosyncratic execution issue versus a broader based difficulty engaging a consumer that is being squeezed in a significant way?
I think it's very difficult. And if the C-suite can't forecast where their own company is going, how do we expect the Federal Reserve to forecast where the whole economy is going? Tremendously difficult. Futures down 0.4 on the S&P. On the Nasdaq, we're down 5 or 0.6%. The euro's weaker. Euro dollar just about holding on to 101. With Tom Keene and Lisa Brownbitz, I'm Jonathan Ferro. This is Bloomberg.
back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound.
Okay.
And that crack is a sonic boom.
Yeah.
I think the way they got a date was to impress the females by making loud booms.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
The latest bear market rally is full of wishful thinking. We still need a profit forecast reset. The words of Lisa Shallett of Morgan Stanley Wealth Management. I'm thinking of Walmart this morning off the back of those comments. Bramo's going to go through those numbers for you in just a moment. Futures are down 1/3% on the S&P. On the Nasdaq 100, we're down 0.5%, going into big tech earnings after the close a little bit later. Those big tech earnings keep coming through tomorrow. Then on to Thursday, we'll hear from the likes of Apple and Amazon. In the bond market, a little bit more curve inversion for you. 10-year yields down 3 basis points. The 2-year down just 2 basis points. Somewhere between 20 and 25 basis points inverted, 2s versus 10s. And maybe that gets a whole lot worse if we price off what's happening in Germany. Yields come in again because the growth outlook for Europe, not just Germany, gets worse. Let's take a look at the euro. Euro dollar rolling over, a weaker euro against everything this morning. Euro dollar 101.40, negative 0.8%, just about holding on to a 101 handle. Tom, where do you want to start? Where do you want to begin? EU nations have to come to some kind of agreement to pull back on the use of Russian gas. Then on the Russian side of things, we don't know how much Russian gas we're actually going to get that comes into Europe. All of that just spells weaker growth.
I'm going to go all OBE on you, overcome by events. That's what the tape looks like to me. You look at the Bloomberg screen, John, equities, bonds, currencies, commodities, particularly using currency with a depth of market. These are indices on the move. They're just barely getting going. We're trying to get out front. And the bellwether to me is strong Swiss franc against euro.
Trying to get to September for that next ECB
or August,
meeting.
Yeah.
I've got no idea.
When's the ECB meeting? There. Somebody asked me, I go, I don't know.
September 8th, I think.
Okay.
Tom, I might be wrong on that. I'll double check.
Lufthansa will be
8th.
flying by then.
Let's hope. One-day strike out of Lufthansa, Tom. We're going to see a lot of this in Europe this summer, aren't we?
Yeah, no, the strike thing is a huge, huge deal. And, you know, you see settlements. I believe UPS settled over here. But, you know, over there, I mean, British Air, I think, is in the mix of it right now.
I can tell you, anyone that's flown Lufthansa through Frankfurt probably felt like there was a strike on them at the best of times. Tom, you know, I've been stuck in that airport for the best part of 8 hours before. And they sent me a message and said, we hope you enjoyed your time in the airport.
Yeah.
Have you ever spent time in Frankfurt Airport?
No, the only one I know.
Anyone that's enjoyed their time in Frankfurt Airport.
Yeah, the only one I know, John, who spent more time than you and me in an airport, Combo. Bramo spent more than you and me combined.
I'm sure she did. I'm sure she did. Bramo joins us right now with some stocks on the move, and there are many going into earnings a little bit later after the close.
And we've been talking all morning about Walmart, but I really want to sit on it for a minute with those shares down almost 10% ahead of the open here after downgrading their forecast for earnings for the remainder of this year. And this is the key to me, and next year. These margin pressures they expect to continue. Yes, perhaps this is an execution issue given they have all of these clothes where they've got to be cutting prices and that people are buying food where the margins are smaller, but there also is a broad broader story, and you're seeing that throughout the entire retail complex. Amazon, which is going to be reporting earnings on Thursday, those shares down 3.5%. How much are the same stories really exemplified in Amazon's earnings that we see in Walmart? Do we see them continue layoffs of some of those warehouse workers? Do we see them double down on trying to retrench from the expansions that we saw during the pandemic? And UPS giving a flavor of that this morning as well by actually saying that fewer packages than expected were sent around. Shopify also down almost 5% after Citigroup cut their price target for these shares. If you take a look, there is a big distinction throughout the retail complex between those that can raise prices and those that can't. Perhaps Walmart is those that can't. Those that can include Coca-Cola and McDonald's. You are seeing Coca-Cola shares up nearly 1% after reporting earnings that were better than expected. McDonald's actually also performed well, but those shares down 0.1%. And 3M doing pretty well, shares up 4%, even though they had a pretty bleak outlook because of spinning off their healthcare unit in some sort of sale that people are cheering, at least for now. But really, I do wonder, Tom, some of the margin pressures there and some of the downgrades to their forecasts, I wonder when that's going to come back into play here.
We're going to have to see what 3M does there. It's been a troubled company for 10 years. There's no other way to put it. I want to do one total return here. In the last 10 years, and this is a good lead into Christian Muller-Glissman, in the last 10 years, McDonald's is up 14% per year, where Walmart underperforms by 600 basis points, up 8% per year. Every stock is not the same, and every sector is not the same. Christian Muller-Glissman joins us with Goldman Sachs right now. I'm going to go on a limb, Christian, and say sector analysis and sector choice in the next 12 months is absolutely critical. Which sectors will win?
Yeah, no, it's a big change to the last cycle, as you said, where I think most sectors went up together. You just had to be invested, and I think you had a good return. I think which sectors are going to win? I think we all know the market is incredibly bearish on the cyclicals now, especially industrial cyclicals. So if you consider like kind of new orders over inventories on ISM, some of the flash PMIs we got, they are kind of below 50. So if you ask me about the next 12 months, one probably needs to start thinking about cyclical exposure, maybe more industrial cyclical exposure. But clearly right now that feels too early. Because we're in this kind of very weird kind of backdrop where there's a lot of bearishness, a lot of news, which has been bearish, but we're still seeing a lot of negative surprises. So it's a bit too early for cyclicals.
Christian, I'm not going to mince words because there's nobody on Global Wall Street watching this show. And that is, I looked at UBS's 10-year track record, and it's an outrage, as is the Euro Bank's an outrage of shareholder representation. Do you and Goldman Sachs in London, do you skew to a U.S. company selection, or can you buy Europe?
Listen, I think you said it already. I think Europe had a tough last cycle. There were a lot of headwinds there, notwithstanding the euro area crisis. And generally, in a world of lower inflation, I think Europe has suffered. And I think the problem now, you shifted to a world of higher inflation, where you could argue maybe now it's the time for Europe. But sadly, a lot of that high inflation is because of energy, and Europe is hit particularly hard. And you mentioned it earlier, the gas issue is not gone in investors' minds. And also for us, there's a risk that in the second half, you still have disruptions. So to me, it feels like for investors, you have to be very selective in Europe. You need to look at business models that are not necessarily as badly exposed to a gas-induced recession. There's not many. No, I think everything is interlinked. We've been very focused on infrastructure, for example, as an area to maybe hide a bit in Europe.
Christian, it sounds like you think the dollar is going to remain strong versus the euro based on that outlook for the euro region. How does that factor into where we see earnings estimates, especially as we see the headwinds that the likes of Coca-Cola are putting out there, which run in the billions of dollars?
Yeah, I mean, don't forget, Europe is not in a much better spot. We've had the earnings season kick off, and we've had a negative surprise of 3 to 4% on EPS, which is the first big miss in the European earnings season since the COVID crisis. You had like a kind of a third of the companies miss by a significant amount, which is the last time happened during the euro area crisis. So sadly, Europe, on a relative basis on the earnings side, is also not doing particularly well. It doesn't have these blockbuster names, and that's why maybe it doesn't get as much press coverage. But sadly, the European earnings season is not starting off well as well.
So, Christian, given all of the concern out there, and we were talking about the partition between Ed Yardeni and Nouriel Roubini, What do you do as a portfolio manager? Do you hold a lot more cash? Do you hold a 60-40 and hope for some sort of reversion back to a relationship that's traditional? Or do you go whole hog into U.S. equities and say that they are the best inflation hedge out there?
Yeah, I mean, listen, you know, we've said in the past that like the 60-40 portfolio is very vulnerable to really rising inflation and the market repricing valuations across assets. That was the story of the first half of the year. Now you're going back to a bit more of a template we know well, which is recession risk and weaker growth. The market has shifted completely away from inflation concerns towards recession concerns. And I think then the bond market can help you, and it has already helped you a lot. We've upgraded duration to neutral kind of a month or so ago, but it's been remarkable how quick that rally was, and that worries us right now. I think the market has shifted a lot to bad news is good news again. This whole idea that central banks will pivot because the data is so bad. And I think now we are again quite vulnerable from two perspectives. First of all, the data might continue to be so bad that the buffer for bonds is not sufficient anymore. Because the yields have declined so much now, real yields are much lower. So that's an issue. But the second issue is maybe the central banks won't respond as quickly because inflation from a level point of view is quite high. So to answer your question, I think there's still a case to have a bit more cash in the portfolio, to look at option overlays, to look at defensive positioning within asset classes, up in quality.
Christian, thank you. Christian Muller-Glissman there of Goldman. And the final point that Christian's making, I think, is a really important one. We thought this summer we'd shifted from a Fed put to a Fed call. And ultimately what that meant, Lisa, is that we thought we'd capped how far markets could go because any easing of financial conditions would be considered an unwarranted one, an undesirable one in the Fed's eyes because they wanted to keep them tight, keep financial conditions tight and ultimately bring down inflation. But they've eased a lot, particularly high-yield credit spreads. They've come in, what, Lisa, 90 basis points or so? Tighter over the last few weeks?
It's been one of the biggest rallies in high-yield bonds for the month, going back to the peak of 2020 when the Fed was jumping in with the rescue program during the pandemic. How much does the Fed's discussion after the meeting tomorrow really hinge on trying to retighten some of those conditions, pushing back on how quickly they will reverse positioning, reverse their cutting, and going back to cutting the way that the market currently is pricing? And if they don't, how big of a disruption could you see, not only in bonds, longer-dated bonds, but also in stocks as people retrace the Fed's reaction function?
Would you like the Marko Kolanovic take on things?
Well, I think I know it.
With the peak in Fed pricing likely behind us, you might have changed. He said, with the peak in Fed pricing likely behind us, the worst for risk markets and market volatility should also be behind us. Lisa, he hasn't changed.
No, I was about to say,
he's
he
still
hasn't
bullish.
changed.
No.
I mean,
I would have opened the show with it if he hadn't changed.
That would have been the top of the show.
He's still bullish. What do you make of that, Tom? With the peak in Fed pricing likely behind us, the worst for risk markets and market volatility should also be behind us. Kolanovic over at JP Morgan.
I would say 44% of our audience's heads are spinning on radio and television. John, the gap here is so wide, and I go to what Anna Wong of Bloomberg Economics framed out an upper range of a terminal of 5%. That's unimaginable. That is anti-Kolanovic. There's no other way to put it.
Trying to get visibility on this economy. We'll do that shortly with the CFO at General Motors. Looking forward to that conversation from New York for our audience worldwide, with futures down 1/3%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Union is preparing for the possibility of a full cut-off of Russian energy supplies. EU nations have agreed today to cut their natural gas use by 15% through to next winter. The rapid pace of agreement reflects the dwindling gas flows from Russia. Supplies through the key Nord Stream 1 pipeline are set to drop to around 20% of capacity. Now, the former President Donald Trump returns to Washington today for the first time since leaving office. He'll make a speech to a think tank that is working on an agenda for a possible second term. An aide said he will focus on public safety. His visit to the Capitol comes as the January the 6th committee has been detailing his attempts to remain in power and his refusal to call off a violent mob of his own supporters. It is the first major effort by the US Congress to regulate big tech since the beginning of the internet. Lawmakers could vote on the American Innovation and Choice Act before midterm elections. The measure would lay down ground rules for dominant firms such as Alphabet's Google, Amazon, Apple, and Meta's Facebook. General Motors has posted second quarter profit that was weaker than expected. Semiconductor shortages limited vehicle production. Still, GM maintained its guidance for the full year. This reflects robust demand for its highest priced SUVs and trucks, and it signals optimism that GM can get the chips it needs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that on June 16th, when we fell down to 3,666 on a closing basis, I think that was the bottom. And coincident with that is we have seen commodity prices coming down. We have seen a slowing in the economy, which I think will help to moderate inflation.
That was the great Ed Yardeni making the call that maybe that bottom in the middle of June was the bottom. Futures right now on the S&P negative 1/3%, on the Nasdaq down 0.4%. A lot of talk about Walmart cutting their outlook. We'll pick up on that story in just a moment. A lot of talk about Europe. Euro dollar negative 0.9% now. That is a weaker euro at 101.30, and some difficulties with Russian gas once again. Nord Stream 1's back online, but running at 40% capacity and about to come down to 20. Tom, and the Europeans agreeing that they need to cut back on gas consumption by 15%. Ultimately, you put it all together, you've got weaker growth in Europe. That's the outlook.
There's no question about it. Right now, the growth in America, well, that may be a mystery too, whether it's the middle class flat on their back or maybe some of the better numbers we're seeing this morning, including out of Generous Motors of Michigan. Joining us now is the most interesting guy in automotives. Why is that? All you need to know is Mary stole Paul from Ed. Paul Jacobson out of Auburn was the CFO of the aviation business when the aviation business was flat on his back. Mary stole him to bring him up to General Motors a number of years ago, and we're thrilled Paul Jacobson could join us this morning. After dealing with aviation, Paul, the auto business must be like a walk in the park.
Well, thanks, Tom. Really excited to be here with you all today. And we've certainly had our share of challenges in my first year and a half, but it has been wonderful.
My challenge, Paul, is the middle class of America can't afford a new car. You've got the Hummer HEV Edition 1 at $112,000 whatever in your driveway. The middle class can't afford a Chevrolet. How do you make new cars affordable to the middle class?
Well, we've got a lot of affordable products on the way, and what we're doing, we're already producing the Chevy Bolt, which is a great EV alternative at a lower price range. The Chevy Blazer right behind me, which we just debuted, is coming at a lower price point. And we've talked about the Equinox EV, which will come at about $30,000. Right. So our goal here is to really provide electric vehicles across our entire customer portfolio, and that's one thing that General Motors has done very well through its history.
I spoke to our David Welch, who knows a lot more about this than I do, and he said there's only one question. What are you doing about supplies, the chemistry of battery, the stuff Mary Barra is good at, not you, but the chemistry of batteries, the manufacturing of batteries. How do you fold battery development into the end of this year and into 2023 to sell more units?
Well, we've been very thoughtful about our approach, going back to the design of the Ultium battery platform, which gives us the ability to make a diverse suite of vehicles, whether it's the Chevy Blazer behind me or the Bright Drop van or the Cruise Origin across the board. It gives us a lot of versatility. But one of the challenges that the market's been talking about a lot is how do we get the raw materials to do that? And I'm pleased to report that our team today, we've announced that we've secured all of the battery raw materials needed to produce 1 million vehicles in 2025 with binding agreements. So we're ready to go. As our Ultium facility in Lordstown, Ohio begins production in just a few weeks, we'll be able to rapidly scale our EV production and make progress towards those goals.
So that's the electric vehicle side of things, but every vehicle that is produced is now a computer, evidently, because of the chips that are required to give them all of their features. You talk about chip shortage persisting and that you're reducing your potential output as a result. How long do you see that persisting for?
Well, this is something that we've been working through really since December of 2020, and I think the team's been remarkably resilient in our ability to manage it. We know that this year, as we've talked about, we're going to see production up 25 to 30% over last year's levels. We've seen a first half that's up year over year. That momentum will continue and grow in the second half as we lap the challenges that we had in the third quarter of last year, particularly around Malaysia. So they've done a really good job in the short term. Longer term, we're focusing on simplifying the semiconductor architecture inside the vehicles and going with much fewer chip families that are going to enable us to partner deeper through the supply chain and more consistently in the long term.
You also say that you're going to reduce discretionary spending and limit hiring to critical needs. We've been talking a lot about the labor market and when it's going to start to soften. From your perspective, what does it mean to limit hiring to critical needs? When does that turn into reductions in overall staff count?
Yeah, so we're not contemplating any layoffs. We don't have any plans to lay off workers. We went through a fairly big restructuring back in 2018, in which the company, prior to my arrival, did an amazing job of saving $4 to $4.5 billion annually, and paving the way for the investments that we need to make in the cost structure to produce EVs. So as you see us going into 2022, we called out a lot of headwinds, over $5 billion of inflationary pressures year over year, and said that we were going to adjust some of our growth plans to make sure that we were moderating that and being disciplined in how we brought fixed costs in.
Paul, one final question. The emotion here is a GM with a drawdown from the share high here of 47%. I want to focus on the miracle of the aviation business, which is you ended up developing persistent revenue, more responsible revenue, and more persistent free cash flow. Can you do the same miracle in the American automotive business? It's been basically a walking train wreck for 10, 15, 20 years. Can you bring the financial discipline to develop persistent free cash flow to General Motors?
Well, what I'm really excited about the opportunity here at GM is it's an industry that's in transformation, not just a company. So when we look at the capabilities of electric vehicles and what they can bring to consumers, we're focused on the entire universe of revenue opportunities beyond just the first sale of the vehicle.
Yeah.
And a great example of that is the deal that we just announced with Pilot Flying J to bring charging infrastructure to America's interstates. So with more than 2,000 highway chargers, we'll have a network that will provide great benefits for GM customers, and that's the recipe for generating strong cash flows for the future.
Paul, this was an okay interview. The problem I have is the car behind you. For those of you on radio, the blazer behind Paul Jacobson is a crimson color, much like the University of Alabama. Paul, bad form, is an Auburn guy. You just can't have a crimson car behind you. Thanks so much.
Yeah, well, I tried to push for orange, but this is a much more attractive color.
There you go, John. John, it's about football always if you're from Alabama.
Paul Jacobson of GM. Great to catch up with him. Tom, you mentioned the stock. It's down 41% year to date. Had a great year last year, unwound pretty much all of that this year.
I keep very careful track, John, of how wrong I am. Shout out to Itay McCauley of Citigroup, who basically hit me over the head X number of years ago and said, go long GM. And up until the beginning of this year, it's one of the Itay McCauley's call on GM has just been brilliant. And you wonder what they're going to do. I mean, is it a tech company or an auto company?
Well, last year it was a tech company, Tom, and now it's just been left for dead this year.
Yeah, no question.
Market attitudes change and change pretty quickly. I don't think this year you wanted to be considered a tech company, did you?
John,
that's the
my
difference.
question is the middle class been boxed out of the new car market? And the answer is they have.
Futures right now down 1/3% on the S&P, on the Nasdaq down 0.4. Euro weakness, a story we'll pick up on in just a moment. From New York, this is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, we haven't seen the downside on the economy.
Right now, we do have a cycle of things that are slowing.
It doesn't feel like a normal break into what we would call a recession.
I think it's a mild recession at best. I think it's a mid-cycle slowdown.
The idea this is going to be short and shallow.
Okay.
It's totally delusional.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, Bloomberg Surveillance from New York. Thrilled you're with us on radio, on television. Where to begin? And maybe the sum is what the yield market does. A 2-year yield falls below 3%. And in Europe, just simply lower rates. John, growth slowdown speaks volumes.
Looking for more economic weakness, particularly in Europe, Tom. What a tough time for the continent where they have to push back on gas use in Europe because ultimately they might get less supply out of Russia. Euro dollar, Tom, 101.31.
These are persistent falls, and they're seen within the oddities of the earnings season in America in full swing. The text this afternoon, some of the bigger consumer and industrial companies this morning. And John, what's interesting is within the tangible struggle company to company, some do well and others less so. Walmart.
Let's talk about the less so. Walmart's down 9%. There's clearly a shift in the product mix, which we've identified now for the last couple of quarters. We're clearly experiencing higher inflation, and the spend is going on that, food and gas. Where the spend isn't going, Tom, are the discretionary items we all wanted in lockdown. So what did these companies do? They went out there and got as much of the stuff as they could. Then they've got too much of it. And that's the difficulty the C-suite is having. It's both an execution problem, Tom, and it's a problem with the consumer.
And the challenge here, Lisa, is you bring it over to the politics of the moment of a middle class flat on their back, and it's a Republican and presidential debate as well.
Yeah, they're trying to basically frame out what it means to have a technical recession versus a real recession, why we're not in a recession. Out of that soup, what we're seeing right now from companies as they report earnings are the ones that can raise prices, McDonald's, Coca-Cola, and those that can't, that are actually cutting prices, as John was saying, which is the Walmart, which may be the Amazon, some of the other companies. How much is this a trend? And how much, Tom, to your point, is this a specific company by company story of execution and management as they deal with different types of goods, as they deal with different types of clientele?
And John, what's so important about Lisa's sharp explanation is the basic idea of the partial differential or dynamics of price in units at the revenue line. Walmart says units are pretty darn good, but price is just not there.
We've got a margin problem. Ultimately, the stock's down 9%.
70 basis points.
But Tom, I think we've got a bigger issue than that. These are things we've been discussing now for weeks. Since the last earnings season, we were talking about this. Then you get another warning. You look at the price action. I often say this, and many people say this, Tom. You look at the information, one, then you look at how the market responds to the information, two. And the latter's telling you a story that this is not priced in. The fact that Walmart's down 9% tells you that this is not priced in.
Yeah, John, we've got to talk about the research piece of the morning, and this is something I'm sure Dr. Larian will write about, among others, Lawrence Summers. Anna Wong of Bloomberg Economics frames out an upper range of where she thinks the Fed's going with a 5 handle. John, I've never seen that.
That's the upper range. What's the base case?
Four-ish.
Four-ish.
Middle.
So alongside what Citi are calling for, Tom, year-end.
Yeah, or above that a little bit. She shifts up a stick on the upper range. We're completely unprepared for that across all
Yeah, the
markets.
4 handle is not consensus, Tom.
Yeah.
Not at all.
Yeah, completely.
And the 5 certainly not.
Okay, I'm going to do the data check right now. John, help me out here. I literally don't know where to begin today. So I'm going to begin with the equity markets, which frankly, John, are more resilient than what I would expect. S&P futures negative 15, the VIX 23.96.
Just a little bit softer, lighter, lower, negative 0.5% on the NASDAQ going into earnings from Alphabet and Microsoft after the close. Then on to Meta tomorrow, Facebook. Then on to Thursday with Amazon and Apple. In between, we get a Fed call. And going into that, yields are coming in. 4 basis points on a 10-year, Tom, 275.40.
Meta, thank you.
I'm with you, Tom. I don't like it either.
I love it.
I don't like it either.
They wanted a 4-letter word. They should have just changed it to Tang.
Alphabet, I can go with just, and it's taken me a while, but
I like Meta.
What do you like about it?
It makes me feel philosophical. That's great. Meta. You know, in the world, that's the other world that's created. Carry on, Tom, please. Let's move on.
Sarah Malik saves us this morning, Chief Investment Officer of Nuveen. Sarah, you have to readjust and rewrite the market call for Nuveen. What category of readjustment are you thinking about right now as you see earnings and as you see the economic data come in?
We've been thinking that earnings could easily be the next shoe to drop for the markets. If you look at consensus estimates, they were up high single digits coming into this quarter, and that's going to be the issue going forward. You're seeing this with these companies. The ones that have pricing power are going to be the ones that win. Just talking about technology, they're dealing with currency issues, macro issues, and potential estimate cuts. And just breaking down Alphabet and Microsoft, both of these companies have outperformed the tech index year to date. We think Microsoft is more defensive. They have more of a resilient commercial business, a nice dividend yield of about 1% to protect them. Alphabet likely runs into the same ad-related issues we saw with Snap and with Twitter. They've been investing heavily in their cloud and their AI business. This could hurt their margins. So, within that world, we think Microsoft probably puts up a better numbers and outlook than Alphabet does.
Sarah, where does it leave an Amazon?
I mean, Amazon is a challenge. This is a company that's been making the right investments in the shorter term. They've taken so much control over their logistics business, but they could easily run into that same retail problem we're seeing with Walmart. The consumer is an issue because they've been dipping into their savings in order to spend. So the consumer is not as resilient as they've been in the past. They're more sensitive to prices, and we've seen that pretty rapid shift in spending from goods to services. I think that could be an issue for Amazon in the short term, but both Amazon and Alphabet are very well-positioned companies over the long run. So this is just short-term pain for a lot of these technology companies.
So given that you are seeing that probably some of the downward revisions are not being fully priced in, where do you see this earnings season taking the S&P through the end of this year, given what we've seen so far?
it's interesting. If you look at the prints for this earnings seasons, overall, we're actually seeing moderate earnings beat. So it looks like a good earnings season on paper. It's just the outlooks are murky, and weighing all of that together has to do with other things we're going to see this week, like GDP, for example. That could come in close to flat. It could easily come in negative. That means we likely already are in a recession. We're seeing cracks in manufacturing data. Employment's been holding up, but that tends to be a lagging indicator. All of those are going to play into earnings season, and whether those estimates can hold up going forward, we don't think that they can. We think those estimates need to come down. That's the one factor that really hasn't budged this year, while so many other data points have deteriorated.
I want to elaborate a little bit more on something you said, that we probably already are in a recession. This is the political discussion is parsing the difference between the technical recession and a real recession. How does this really shape your view, your belief that we're in a recession, regardless of how you define it, and that we may be climbing out of it, but we're already there?
Well, odds are we're either in a mild recession, and we also feel like otherwise it's going to be hard to skirt that recession. So then we turn to market valuations and the conversation of what's priced in here. I don't think everything is priced into these markets. We think the S&P likely stays in a trading range of S&P 3,600 to 4,600 until something happens, and that is inflation breaks one way or another. The good news is we are seeing it cooling, or the Fed pivots. There's expectations the Fed could pivot in early 2023. That sounds optimistic to us. We're coming into a 75 basis point rate hike tomorrow. The interesting thing out of the FOMC will be what kind of guidance do they give in terms of how far past neutral they'll go, and what do rate hikes look like for the rest of this year.
Sarah, how do you think we'd respond if the chairman acknowledged some of the weakness in the economic data? Do you think that could get problematic quickly?
I think that would be mostly an expectation. 75 basis points and the Fed admitting that economic data is weakening and they'll stay data dependent would be something I think the markets expect. What we'll be curious about, though, is how much more are they going to tighten going forward? How far past neutral? That's going to be the tea leaves that everyone's reading to try to understand, are they becoming more hawkish or less hawkish?
Sarah, awesome to get your view on things, particularly earnings a little bit later from Microsoft and Alphabet. Sarah Malik there of Nuveen. Tom, looking for the tea leaves, trying to read them ahead of September. That's what this meeting tomorrow is all about. It's the meeting in September, not this one.
Well, that's often the case. I would suggest, John, what we're talking about here is a swing to neutrality on our way to restrictive. I have no clue where neutrality is. I have no clue where restrictive is. I am certain we're moving away from accommodation.
I am certain they don't know the answer to that either, Tom. And Lisa, that's the problem.
When was the last time we were restrictive, Lisa?
In what capacity? I guess people would go back to probably decades ago by the time we saw actual restriction. I'm interested to hear their messaging given the loosening in financial conditions. Do they want to see them tighten? And John, this speaks to something you were talking about. If they acknowledge weakness, does this become a problem for them? Does it confirm what you're seeing getting priced into the market already about rate cuts next year? Is that a really bad thing? Are they not going to acknowledge that because they want the tightening to continue? They want markets to fall. They want yields to go higher. That was the whole playbook, and the market's gotten ahead of itself and gotten too derivative. How much are they going to push back against that?
And that's the Alerian flip-flop warning from weeks ago. You remember?
Yeah, I do.
That's
and
potentially teeing it up.
I mean, that is really the issue. And I keep going back to Julian Emmanuel's point, and I really can't emphasize how interesting this point really was, that if the Fed has to reverse course and cut rates next year, that could be the trigger to unmoored inflation expectations. That could be the real problem. So at what point does the Fed say, look, we could go slowly, or we could go slower than some people expect, but we got to keep them there, to Alan Ruskin's point, for much longer than people previously expected.
I'm with you, Lisa. I think this is really important about when they cut interest rates. The next person that comes on a program and says rate cuts in September 23 or whatever, Tom, we've got to ask them, where's inflation when they think the Fed's about to cut interest rates?
I just think it's too much. I don't think there's any. I just don't think there's value in it other than the gaming of it within the futures markets. You know, I'm sorry. I don't think there's any value in it.
No value on the south side right now, Tom?
I don't think there's any value in gaming out, up we go, and then we go down. Where's the pivot point? Blah, blah, blah. You know?
Okay. Anything else?
No.
Cool. All right. Well, I can't wait for the interviews tomorrow.
It's earnings
around the
season.
Federal Reserve decision when we have special coverage for 2 hours.
Team coverage.
This will be great. Why don't you do a promo later and just say there's no value in this?
No, I just think the gaming out 18 months is absurd in a post-pandemic America.
Tom, the market's always gaming things out 18 months out.
Well, okay, I don't think it's a value right now.
You think so? You don't think financial markets are of value? Essentially, that's what you're saying.
I don't think the game out 18 months is a value, period.
Okay. How do markets function if they're not
I'm way
anticipating and
more
trying to discount the
interested.
future?
I'm way more interested in Priya Misra reframing a 50 basis point inversion.
Okay.
Way more interested in that.
Looking forward to that conversation later. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Union has agreed to reduce natural gas use 15% through to next winter. That comes as a prospect of a full cut-off from Russian supplies grows increasingly likely. Energy ministers meeting in Brussels gave the green light to a proposal to voluntarily cut their gas usage over the next month. General Electric has surprised Wall Street today. It posted better than expected second quarter profit and a positive cash flow. Sales at the key jet engine unit GE Aerospace soared 27%. Still, CEO Larry Culp continues to battle inflation, supply woes and shrinking demand for wind turbines. He's preparing to break up the conglomerate starting next year. Coca-Cola beat Wall Street estimates for second quarter sales. The soft drink giant reported a 16% increase in organic revenue growth. Coke also raised its full-year guidance. The company says it has increased prices 12% on average. Global news 24 hours a day on air and on Bloomberg Crypteg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Everyone's looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg, your global business authority.
It's about the economy. If the economy starts to slow, given that the Fed gets rates into a modestly neutral stance, the equation changes at the Fed. The Fed needs to have a policy stance, a trajectory on inflation, and dynamics on growth that gives them comfort that in a year to year and a half's time, inflation is going to be below 3%.
Great to catch up with Bruce Kasman there of JP Morgan from New York City this morning. Good morning with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market looks like this. We're down 0.4% on the S&P. On the Nasdaq, we're down 0.5%. Walmart getting hammered this morning after cutting its profit outlook. Once again, we're getting used to this from the retailers. We're getting used to the price action too. We're down 9% in the pre-market. Yields are down 6 basis points. Growth concerns over in Europe bleeding over to things here in the United States. 274, sub 274 now on a 10-year in America. And look at a euro. Euro dollar negative 1% to 101.20. Concerns about Russian gas supply, higher gas prices, and lower consumption of gas going into winter from Europeans, Tom, all weighing on the outlook for growth.
I really can't say enough, folks, about the tensions in the market this morning. It's exceptionally complex, particularly as, John, you'd think normally before a Fed meeting it'd be pretty quiescent. It's not. There's no other way to put it.
Not with Europe in the mix, Tom. Not right now.
We're going to rip up the script now, and we can do this with French Hill. To say he's a Republican from Arkansas barely mentions his financial services life, his banking life. He is hugely qualified and respected on Capitol Hill to talk about our central bank. French Hill, one of the jewels of Bloomberg is a guy named Craig Torres. He's been writing on the Federal Reserve for years, and he sent me a blistering note over when is there going to be a transitory investigation. Let me cut to the chase. Your Washington is transfixed with January 6th, and there was May 1, 2019, where the word transitory was launched by the chairman towards an inflation theory. Do Republicans and Democrats have to investigate the path from transitory?
I think so, Tom, and I don't disagree with that. You know, a lot of the challenge that we have now is that the Federal Reserve's monetary policy is late in the face of the tremendous fiscal stimulus. They should have begun shrinking the balance sheet in 2020. They should have come off zero. And part of that was Jay Powell and the board agreeing in August of 2020 to let inflation overshoot their 2% target, saying that they were not concerned about it because for so many years, they'd been having a hard time getting inflation to 2%. So I think it deserves a thorough investigation, but I think we'll find that the pandemic just jumbled the Fed economic forecasts and Congress's response.
There has to be a respect for the uncertainties of economics. Are we asking too much of our institutions, and particularly our central bank, given the shock of a once-in-a-lifetime pandemic?
Well, I think that's conceivable, and I don't expect to take too much pressure off the Fed, because I think a lot of people, Democrat and Republican, in the summer of 2020 and the fall of 2020, thought that we should stop buying $120 billion a month and begin to taper and maybe start setting out expectations for coming off zero. And we did not do that in the face of tremendous fiscal stimulus, again, from 2020 and 2021.
Well, given the economic uncertainty that we currently face, regardless of what previous policies were, do you think that it's better for the Fed to err on being much more aggressive in curtailing the inflation now, even if it causes unemployment to go up, even if it causes people to lose their jobs, which a lot of people say is necessary, a necessary evil to bring inflation down?
Well, Lisa, I think we should focus on price stability at the Fed. I think that should be their core mission. They shouldn't have let it get out of hand, and so they have to focus on price stability to return their good judgment and their reputation. But Congress and the executive branch can be focusing on the supply side, getting any barriers away from people going back to work, unleashing American industry, not adding to regulatory burden at this critical moment, not proposing to raise taxes. Those are all things on the supply side that I think would be helpful as we navigate this tough time, as Tom has described, an uncertain time between recession and stopping inflation.
But Congressman, having those supply chain fixes are going to take time. That is something that we have seen repeatedly, even with passing potential bills having to do with semiconductors and bringing some of the production back to the United States. What do you do about an unemployment rate that is expected to rise, a labor market that many people say has to weaken in the face of inflation in order to get us back to where we need to be?
Well, I think that's inevitably the cost, as Tom says, of making mistakes in the past. We've seen this movie before. It's very tough to put inflation back in the bottle and cut expectations. The Fed has that obligation to price stability because inflation is a thief. Families are also hurt by $5 plus gas and the effects of inflation. You're seeing Walmart's announcements today. Why is it down? It's because consumers are being crushed by inflation. So don't forget, these are two sides of the economic charts, and they're both unpleasant.
Fred Hill, I want you to speak to Arkansas right now and the rest of the world. What do we not get about your Bentonville, Arkansas? What's the number one thing Global Wall Street doesn't get about the pixie dust of Bentonville, Arkansas?
The Ozarks, an amazing place, great food, great water. They didn't have any roads, Tom. They had no infrastructure when Sam Walton created Walmart, when J.B. Hunt created J.B. Hunt, when Don Tyson, the elder, started Tyson Foods. It was just a country town. And so to me, it's about American ingenuity, American perseverance, not taking no for an answer. And that continues now 60 years later.
John, that was a Chamber of Commerce announcement from Arkansas.
I think that was the promo.
That was a promo.
Tom, Congressman, thank you. French Hill, the Republican from Arkansas. On the Fed, we've got to get into diversity of thought as well. It's a big issue. Groupthink has been a problem at the Federal Reserve for a long time and remains that way. And for those of you that thought they got their act together at the end of last year, I'd say look back to the December projections for 2022. Where do you think they saw rates in 2022 on December 21? They saw Fed funds in 22 at 0.9%. 2023, they saw Fed funds at 1.6%. 2024, they saw Fed funds at 2.1%. I can tell you they saw PC inflation this year at 2.6%. That was December coming into this year. And I'm sorry, the Ukraine war stuff, that is not an excuse for getting your forecast this wrong.
No, I feel very strongly the war is removed from this. It was a dreadful call, but as Mr. Hill said there, and I think it's so important, if we go through all sorts of investigations, the overlay will be, but there was a pandemic.
Okay.
That will be the out.
Can I just say, though, John, when we hear about the possibility that unemployment's going to go up and it's a necessary evil, and yes, this is the Fed that might have gotten it too late, there also is a policy prescription here that there isn't a lot of discussion about with retraining and the things that are more complicated. That's a DC job.
On the political side,
yes.
I agree with you. Totally agree with you. And it's not happening. Yields down 5 basis points on a 10-year, 274 from New York. This is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
In many ways, the week begins right now. We've got big tech earnings coming up after the close. Alphabet and Microsoft, then onto the Fed tomorrow, onto Meta. Tom's excited. Then it's Apple and Amazon on Thursday after the close. Futures right now, negative 1/3% on the S&P and the Nasdaq 100, down 0.4%. Bit defensive out there at the moment. Yields down 6 basis points, 273.76 on a 10-year. Yeah. Got to talk about Europe. What is the market check right now without a discussion about Europe? Euro dollar negative almost 1 full percentage point in the dollar's favor against the euro. Euro just weaker, the story this morning at 101.25. And a big concerns, Tom, about European gas.
Yeah, the euro's weaker, but what's important there, John, is the grind down. It's the way it's weaker. And I would also notice in the yield compression, the real yield is stunning at 8 basis points. We've gone from a 0.6x down to 0.36 on the real yield. Can we begin to frame out a negative 10-year real yield again? Is that imaginable?
Or dare I say we'd frame out anything, Tom? Is there any value in that?
I don't know.
Framing anything out.
That's where we are. What we're going to do now, this is a special treat, and we say good morning to Tom Porcelli, who is scheduled to be with us. He is ill. That happens. We wish him good recovery. In stepping in on short notice, we are thrilled to bring you a gentleman that can slice and dice the American economy like no one. Stephen Rasciuto is at Mizuho. He is acclaimed there working on the American economy. Which part is the biggest mystery right now? In Y equals C plus I plus G plus NX. Steve, what's the biggest mystery right now?
Yeah, the biggest mystery really comes down to the inventories, and it comes down to the trade, the net trade deficit. Those are always the most volatile components. We pretty much know what's going to happen in terms of the rest of the components of the report, given the indicators we have. We have 2 to 3 months worth of those indicators. It's the trade and the inventory numbers that leave us open.
What about export dynamics? Bruce Kasman of JP Morgan was talking up that could be a constructive number, adding to GDP, keeping us out of recession. Do you agree?
Well, it certainly is possible. This is what I'm saying. It's the big risk factor. We also know the import side of the equation is still a pretty big drag as well. It's that net inventory number. How much of it got accumulated in the inventory component? That really will be the telling sign. So the final sales numbers are going to look pretty horrific. It's now a question of whether the actual GDP numbers do or not. And to be honest with you, all the debate about whether or not we're in a recession or not in a recession, to me, is kind of an academic discussion. discussion because for most people, it looks and feels like a recession. So if it walks like a duck, talks like a duck, or I should say quacks like a duck, it's a duck. Whether we call it a duck or not is a different story.
And one thing that's not theoretical or academic are the earnings that we're seeing right now, and they're a mixed bag. You're seeing some, like Walmart, that are pretty dreadful, at least in terms of their downward revisions to their forecasts. And then you've got others that are still hanging in there with pricing power, McDonald's and Coca-Cola among them. Is there a takeaway, though, from so far what we have seen from retailers, from the earnings, in terms of the nature of what walks like a duck, talks like a duck, is the recession that you see happening?
Yeah, I think the answer gets down to earnings revisions. We track all the S&P 500 companies. We track the bottom-up numbers, and we look to see how revisions are unfolding in terms of forward earnings. And what we're seeing is a clear downward trajectory. We're not at the levels yet in these earnings revisions where we can say we've reached an all clear, where we've rolled everything in, but we've come a long distance. A month ago, my earnings revision tracker, which is diffusion index, was about plus 0.3%. It's now in the minus 18 area. It needs to get down into that minus 20, minus 30 area, well into that minus 20, minus 30 area for us to be at the point where we've rolled in all the bad news. So there's more bad news on earnings to come.
What does this mean in terms of the nature of the recession that you foresee?
Well, I think what we're going to deal with in here is not the recessions we've been dealing with since 1990. Those were credit-related recessionary environments. Those were environments in which, we had some kind of fundamental flaw in the fabric of the financial system. We don't have that here. So the net result is the degree of the downturn, the length of the downturn, and the ability of it to develop a negative feedback loop, which has been the biggest problem of the last several downturns, is not there.
Steve, you have the joy, and we have the joy of a Mizuho, which is turbocharged with Stephen Rasciuto and a guy named Dominic Constant. Fold in Dominic's analysis of the dynamics of the federal system, almost the Newtonian mechanics of the financial system, I should say, into your economic outlook. How do you dovetail Constant with Rasciuto?
Well, I think we're both pretty much in the same pattern. We do believe that this economy is reaching a downward trajectory and that the Federal Reserve is probably less likely to go from rapidly raising rates to easing rates to rapidly raising rates to more gradually raising rates. We're both in agreement in that environment, and I think that's the real critical message here that differentiates us from most people on the street. Most people want to believe that we have an economy right now where once the Federal Reserve reaches this crescendo in terms of front-loading the rate hike story, that they will begin to reverse policy. We don't see that in any way, shape, or form, and it really comes down to the labor market environment. One of the key things the Federal Reserve needs to see in order to be comfortable that inflation is going to get back to their trajectory is a significant easing up of labor market conditions. And in an environment in which we just went through COVID, where people were ordering not just for just in time, but for just in case, I think the flip side of that on the labor market is people are going to be less willing to shed workers than they normally would in a downward trajectory environment. Instead, they'll look to reduce their hours worked because they had such difficulty hiring workers to begin with. They're going to be reluctant to shed those workers. And I think in that environment, it keeps the Fed more on a rate hike path than on a rate easing path, as a lot of the bulls want to anticipate.
If we extend the x-axis then and have a persistency at whatever level the Fed settles out at their neutrality or even restriction, what does that do to the anchored rate of 2%? Do we migrate towards Adam Posen's 3% is the new 2%?
Well, there's no doubt there's an academic discussion going on that the terminal rate is shifting higher and that the natural rate of unemployment has to be moving up higher as well. I think when you look at some of that discussion, remember, these are the same people who gave you secular stagnation, which put us in the environment that we're dealing with today. So where earlier in your conversation with Representative Hill, you guys were all kind of bashing the Fed, I think you should be bashing academic economists as well who gave us secular stagnation, which was was the fundamental underpinning for what we just did to the economy. And therefore, there's a lot of blame to go around. Blame has to go around even to the financial services community and the economic staff there, of which I am one, in terms of misreading and misforecasting.
Steve, when you say academics, do you mean Larry Summers?
Well, I mean, look, there was a lot of people in that camp. Larry certainly was very, very vocal in that camp. And I think, you know, the reality of the situation, there were a lot of people who fell right along with it. And secular stagnation, I think, is part of the reason why we got to where we are today. And that's not been held to task.
Do you have a sense, though, Stephen, of what people got so wrong that's going to perhaps cause you to be more accurate going forward in terms of what is the new regime that we're in now? Are we looking at a Nouriel Roubini stagflation akin to the 1970s, or are we looking at a blip caused by a pandemic that's going to reset back to that low growth, low inflation kind of regime?
Yeah, I'm not in Nouriel's camp, and I do like Nouriel's work rather significantly, rather constructively. But I think the big difference between now and the secular stagnation environment is what you were talking about earlier in your discussion before I joined the show about the currency. The currency in the 70s was where the euro and the yen are now. The dollar was going down rapidly. It was out of control. The central bank was not doing what it needed to do. I think what you're seeing here is a central bank that is doing what it needs to do. The global financial markets are recognizing that. The currency is moving up on the backdrop of that as well. And I think that's an important and significant difference. The other significant difference is where we are in terms of demographics. We've talked about on this show before. You know, back in the 70s, the baby boomers were moving into the labor market. They were the new entrants into the labor market, and they caused a great deal of dislocation. We're now going from the millennials, which is a big cohort, to the Generation Z. Right. That's a much smaller cohort, and therefore there's a big difference in demographics. So I think those two factors are key. The third factor that separates us from the stagflation environment of the 70s is the energy price gains in the 70s made a lot of America's manufacturing obsolete because it was pre-war technology. Now we're in a very efficient technology where we're capable of dealing with $100 barrel of oil, and we've done that without any great inflationary environment. So I think we're more likely to go through a business cycle of worries about inflation to then resetting back to an environment where we've got to worry more about global deflationary risks. And I think what's happening in Europe, what's happening in Asia, what's happening in particular in terms of Chinese growth should be telling you that in a world where we're building more manufacturing, when we had more manufacturing than we needed before this, we're going to create another excess supply problem on the other side of this equation.
Steve, it's always thoughtful stuff, and it always gets us thinking. Thank you, Steve. Steve Rashuda there of Mizuho. Just in terms of maybe an example of an industry that went out there and created a ton more supply and ended up with too much inventory. It's the retailers, Tom. We've been talking about Walmart all morning. It was Target before.
Well, that's the consumer boom. And, you know, there were some courageous people that talked about this, John, where you front load massive nominal GDP and the good feeling of that. And from the fiscal pop, excess saving, guess what people do? They predict retail's going to spend, so they expand out. And particularly Mr. Bezos and Amazon had to react to that, somewhat a social need and also a business decision. Now what is the major question?
Walmart is set up for 2020, except it's 2022.
They got to what they got to do. This is Hayeki and John. They got to clear the market at 5 times the speed they think they have to.
Austrian school, TK.
No,
nice.
They got to clear markets. I mean, there's been a crisis, and you can blah any way you want. They got to speed up the timeline. And frankly, John, so does New York Wall Street. These banks are going to adjust rapidly.
Peter Cicchini is going to join us around the opening bell of Exonic Capital. We'll be catching up with him. We'll be talking to Clinton Warren at JP Morgan and Joanne Feeney of Advisors Capital Management as well about these earnings still to come from these big retailers.
Never come on my show.
Maybe they'll join as a phoner, Tom, after they've caught up with me.
That'd be great.
I'll try and work it out. Futures lower. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Union is preparing for the possibility of a full cut-off of Russian energy supplies. EU nations have agreed today to cut their natural gas use by 15% through to next winter. The rapid pace of agreement reflects a dwindling gas flows from Russia. Supplies through the key Nord Stream 1 pipeline are set to drop to around 20% of capacity. Now, former President Donald Trump returns to Washington today for the first time since leaving office. He'll make a speech to a think tank that is working on an agenda for a possible second term. An aide says he'll focus on public safety. His visit to the Capitol comes as the January the 6th committee has been detailing his attempts to remain in power and his refusal to call off a violent mob of his supporters. It is the first major effort by the U.S. Congress to regulate big tech since the beginning of the internet. Lawmakers could vote on the American Innovation and Choice Act before midterm elections. The measure would lay down ground rules for dominant firms such as Alphabet's Google, Amazon, Apple, and Meta's Facebook. And McDonald's has reported second quarter sales that topped estimates. The chain said U.S. revenue growth was helped by a strategic price increase and value meals. The fast food chain's digital sales also rose, accounting for almost a third of total revenue for McDonald's. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax. For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think cash flow, stability, good quality companies, when this is all over, are going to be valued once again.
Nelson Peltz, truly one of the most interesting people in finance. We don't see enough from him, we don't hear enough from him, and we do so with David Rubenstein. This is a really interesting and, frankly, folks, important interview on shareholder activism. Nelson Peltz with Mr. Rubenstein tonight at 9 p.m. as well. David, congratulations on dragging him out for some clear conversation. What is the Nelson Peltz model from Ingersoll Rand out to the present day?
His motto is to study consumer-oriented companies, or companies that have pretty good businesses that are maybe underperforming. Maybe they're too complicated, they've lost their way a bit. He buys stock in the company, approaches the CEO, says, I'd like you to make some changes, maybe I'll go on the board, and he tries to increase the value of the stock without taking over the company, and it's worked quite well for him through his firm called Tryon Partners.
And what's important, David, and correct me if I'm wrong, there's not a lot of yelling and screaming. He does this in a measured way. Am I right on that?
Correct. In the early days of activist investors, let's say in the 80s, they took stock positions and they were fairly loud about trying to take over the company or making changes. Today, it's really quiet. He doesn't really do much publicity for what he wants. He tells the CEO agrees to do it, then they don't really have any publicity. If the CEO does not, he may sometimes do a proxy fight, and that can get noisy at times. But he's prevailed generally, and he's made companies much more valuable.
He has a fantastic quote as he was speaking to you, talking about why he dropped out of Wharton, saying that the best advice he ever heard was sales up, expenses down. My father told me that, and that's why I dropped out of Wharton. I knew I didn't need to know much more. That said, from the granular to the macro, he does have a macro call on big tech that the dominance of those stocks does seem to be on the wane. What's behind that?
Well, his view is that you did okay in the stock market in the last number of years if you were in one of 12 different stocks, you know, Amazon or Apple or things like that. But the rest of the buyout, the rest of the world wasn't doing so well, and many of these companies lost their way. And he did very successful proxy fights, and for example, at Procter & Gamble, and he got on the board of Heinz. He got on the board of other companies like DuPont, and he's done quite a successful job of increasing the value of the company without having to try to take it over and leverage up the company.
David, we often get lost in the macro discussions here and the difficulties in gaming out what's going to happen in 6 months, let alone 2 years. From his perspective, and frankly from your perspective as well, is there a very simple, not game, but business to play, taking a look at the nuts and bolts of a business, regardless of what happens, and making smart decisions and being able to identify the companies that are doing that?
Yes, his view is you take a company that's, say, like Procter & Gamble, which had so many different products, and in his view lost its way, wasn't spending enough money on marketing or other kinds of things, and he goes in and presents his position about what they should do and tries to do it relatively quietly, and it's effectively done. Now, interestingly, he doesn't have enough money to do it all by himself, so he does have third-party investors, just like other private equity firms do or venture firms do. And he early on used his own money, but that was not enough to do the kind of companies he's interested in now.
David, a question for you that I would ask of Mr. Peltz, and that is, do we underestimate within the back and forth of the financial media and the recession uproar right now, all the different news flow going on, do we underestimate McDonald's are adjusting and adapting to the cards dealt them?
Well, there's no doubt that large companies, like large organizations of any type, move more slowly. They have bureaucracies, and it's not easy to get something done. It's not easy to get something done to federal government or state governments or large companies. So sometimes these companies are not ahead of the curve. In some cases, good managers have them ahead of the curve, but it's not easy to anticipate a recession or exactly what you're going to do or lay people off well before it's apparent that they have to be laid off. So I would say these large companies are ones that probably have to be prodded a bit by somebody like Nelson Peltz.
Given the fact that you're talking about layoffs, I do want to just bring you this headline. Shopify just confirmed a report initially in the Wall Street Journal that they are planning to cut 10% of their staff. They're supposed to leave by the end of the day. This is a significant part of their workforce, given the fact that they were building up and they weren't one of the darlings over the past couple of years. From your experience, David, how much is this going to be the theme of the next 6 to 12 months of companies cutting back after expanding rapidly due to shifting preferences post-pandemic?
Well, I think you'll see a lot of that because some companies staffed up anticipating we would have growth for a longer period of time than we're likely to have it. Whether we go into a recession or not, there's no doubt there's an economic slowdown ahead of us, and we've already slowed down a bit. So I think some people have probably overstaffed, and I think the tech companies are probably pretty good examples of that.
Did Mr. Peltz talk about Madison Square Garden, small piece of real estate in the island of Manhattan? He's got a nodding interest in that, doesn't he?
He does, and we didn't really get into that very much, but it's something that he's been involved with as well. And, you know, he's a person that takes on a couple companies at a time, one major one at a time, and focuses on it. And when he goes on the boards of these companies, he's generally listened to because he's had a pretty good track record. I would say this wasn't the case early on. Early on, people didn't know what he was all about, but now I think his modus operandi is pretty well known.
David, thank you for the generous time this morning. And I really can't say enough, folks, about this interview with Nelson Peltz. Not all that visible. Rubenstein and Peltz. Bloomberg Wealth, look for that 9 p.m. Tonight as well. Lisa, we've got to get back to the tape. A little bit of equity deterioration, but I'm frankly surprised at the resiliency of equities. DXY over 107 in the yield market speaks volumes.
How much has already been priced in? And that's something that we've been talking about all morning, and certainly with Amazon and their downward forecast, considering the sharp reaction their shares. Shopify, those shares down 11.5% pre-market. It's a platform for online businesses, and online businesses turn to it for a lot of their services. This was one of the most expansionary companies over the past couple of years. For them to come out and say that they're reducing 10% of their staff highlights the moment that we're in. And to David's really good point, how many other companies are right behind it that expanded out dramatically in the wake of the pandemic?
It's a cloud-based commerce platform. I have no idea what that is. I'm, making a joke about it. Lisa, the thing has gone round trip back to where it was pre-pandemic. I mean, basically, it's a pandemic stock, right?
How many pandemic stocks are there? I think of Netflix.
Well, that's
I think
an important
is Amazon going to be considered one of those also? How many others are there that comprise a pretty significant proportion of the overall index in the economy? And these are some of the questions as people start to talk about what's a recession. Does employment have to participate? What happens when the Fed tightens? These are the questions that are getting embedded into these earnings reports as companies come out with less conviction, particularly around staffing.
And maybe this goes to the Fed meeting, and we'll have our special coverage tomorrow. John Farrell's rumors, I'll be there. McDonald's out with a headline right now. Thank you, chart banner, of inflation pressures impacting margin for the rest of the year. I think that's like inflation somewhere out there.
Yeah, I mean, look, inflation is not going away, and I think all these companies are trying to adjust. McDonald's was able to raise prices more than, say, Walmart.
I noticed.
That's going to be the distinction.
I noticed they raised prices.
Yeah, and number 2 value meal.
Yeah, cheeseburger was up, and away. Stay with us. Futures at -17. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Big couple of days coming right up. Live from New York City this morning. Good morning, good morning. Futures down 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, emerging cracks in the consumer.
You're seeing consumer spending drop. Real wages are falling like a rock. You've got really tough earnings updates and guidance.
The consumer has put on the brakes.
Now it's a demand issue.
In the case of Walmart.
Walmart warning last night on weak consumer demand.
We've seen this before.
We saw the issues that Snap had. We saw similar things with Netflix.
We've seen that across a number of companies in retail.
Can they pass on the cost of higher inflation to end consumers?
Pass on price increases to their customers.
A lot of those companies can't do that.
We're starting to see some frazzling of the demand side of the equation.
I'm not so sure about the consumers.
We're going to learn a lot about sort of what to expect as we get through this week.
Walmart down 8% in the pre-market. Joining us now to discuss JP Morgan's Clinton Warren, Joanne Feeney of Capital Advisors Capital Management. Joanne, I want to begin with you. This Walmart story, do we have an execution problem or have we got a broader problem with this consumer?
You know, John, good morning. I think a lot of folks are confused about Walmart. Think about who the Walmart shoppers are. They tend to be those really on strict budgets. They need to shop at Walmart to get the lowest prices. They're willing to put up with some of the hassles. And so I think people shouldn't be so surprised that Walmart is struggling here. More than half their business is grocery, and the other side of the business is going to see a steep fall off as folks just shop for necessities. So you really have to understand that this demand impact of high inflation and falling real wages is really hitting the lower end of the consumer distribution. And those are the ones that primarily shop at Walmart. So they're going to be the ones tightening their belt the most. And Walmart is really going to feel the brunt of this.
Joanne, begs the question, why are we surprised? Why is the market sending the stock down 8-9% on something we've known about now for months?
Well, perhaps the degree of the miss was a bit of a surprise. The amount by which they reduced their forward guidance suggests that this is going to be longer lasting than perhaps some folks hoped. You know, I think that the impact of this inflation story is really disparate. Folks at the lower end are hurt really badly. Folks in the upper middle income and higher really aren't noticing that much. They're remarking on high gas prices and high plane tickets, but they're really not changing their spending patterns very much. And that's why I think some other retail stocks are a real good opportunity. A higher end customer base like a Williams-Sonoma, I think will do well. And folks like, you know, across the distribution, but mainly in the middle to higher end, shopping at TJ Maxx, which is now, by the way, going to pick up a lot of stuff that Walmart isn't able to sell, and they're going to pick it up at a discount. This is really a sweet spot for a company like TJ Maxx.
Futures right now down 0.5% on the S&P, on the Nasdaq down 0.6%. A lot of headlines out there that will spook you. Here's one from the IMF, cutting the GDP growth estimate for 22 to 3.2% from 3.6%. That's not a leading indicator of anything. Here's the Kremlin. According to our sources, they're going to keep up the gas squeeze on Europe. That's been problematic for the European economy, problematic for the euro too. Euro dollar down 0.75% at 101.43. I'll pick up on that theme a little bit later. Clinton, I wanted to come to you. Just on Walmart, you looked at Shopify, the news around Shopify, the news on Walmart. If these companies are struggling to forecast their own businesses, get them in the right spot at the right time, how do we expect the Fed to do that job for the whole economy?
I mean, John, I think you just got to think about if we sat here a year ago and just replayed all the things that have happened over the last 12 months, we shouldn't be as surprised about any of this. Inflation is running higher than 9%. The Fed has done a complete pivot to expectations of 2 hikes in 2022 to a target of 3.25 now. Consumer sentiment is in the basement. Earnings per share estimates are dropping. There's hiring freezes, layoffs, gas is over 5. Like, I don't understand why people are so surprised about this. To me, there's no storm approaching. To me, we're in the center of the storm. We're in the eye of the storm now, and companies are trying to figure out what to do with all this bad information. And they're doing the right things. They are protecting for the outer bands to come through. They're securing their businesses. They're building up reserves, and they're getting ready for what could be our worst days ahead. But my view is, at this point, we've seen so much of it. It's already priced in. The markets were down 30% at one point. Bond markets were down 10%. So we priced in a lot of this, and I think sunny days are ahead.
Clinton, when you say it's priced in, what is priced in and where? Because if you'd said the same thing to me about Walmart, about Target, I would have said, you're right, Clinton. We've talked about this for so long, it's got to be priced in. And then they come out with the news last night, and the stock's down 8-9 percentage points. When you say it's priced in, what's priced in and where?
I think a lot of the risk of recessions are priced in. I think a lot of the movements that the Fed has made are priced in. I think you still will see some surprises from specific companies where people are just now understanding that, to your guest earlier point, that middle America is really feeling it. I mean, making decisions on whether to spend on gas or food or to buy some other clothing is really starting to hit consumers in their pockets. So I think the extent of these misses will make the market moves a lot, but people should not be surprised on a broader spectrum of what is going on in the market and the economy.
I'm surprised they're surprised, and you're surprised too, clearly. Futures down 0.4% on the S&P 500, about 25 minutes away from the opening bell. This was a quote from the CEO of Walmart, Doug McMillon. He said this: the increasing levels of food and fuel inflation are affecting how customers spend. We're now anticipating more pressure on general merchandise. Let's get to Kelly Lyons for more. Hey, Kelly.
Hey, John. Well, as you say, Walmart has taken a big hit in pre-market trading on the back of this news, down about 8.5%. Remember back in February, they thought their earnings would actually be up about 5.5% this year. Then in May, they said actually it'll be down 1%. Now they are saying profits are going to be down as much as 13%. And the issue here, as Joanne was alluding to, they cater to a lower end consumer. That's why save money is part of their slogan. And as that lower end consumer is spending more on gas, on food, on groceries, that weighs on those discretionary items, things like electronics or home furnishing or clothing, all of which are higher margin categories for a company like Walmart. And now Walmart has too much of that stuff. The demand isn't there to meet the supply, so they have to work down that inventory. That's going to mean price cuts. And while that may have some positive impact in the idea of cooling down inflation, it also has a negative impact in that it's going to crimp margins. And of course, that doesn't bode well for other retailers either, especially those catering to the lower end. We've already gotten warnings, profit warnings from Target twice this year. It is down in tandem with Walmart in pre-market trading, as are other stores like Dollar General, down about 4 percentage points. TJX and Ross stores both taking it on the chin as well before the bell, John.
More earnings still to come. Kelly, thank you. On Thursday, I believe we get Amazon. Later after the bell, we get Microsoft. They're two names, Joanne, you like over the long term. Joanne, a question I've been asking this morning of a couple of guests, I'll ask it of you. We've seen a few of these big tech players come out and reduce their hiring intentions, basically pull in job openings, reduce their hiring intentions for next year. Do you expect that conservative stance on hiring to be reflected in the guidance we get offered through this week from those big names?
Things they know investors are looking for is, can they protect their margins? And so I think it's prudent, given all the hiring that has taken place over the last 2 years, as those companies were in the eye of the storm in terms of serving the world as everybody went remote. They did a lot of hiring. They've probably got some people in jobs that they need to rearrange. So there's probably room for them to rearrange folks within the company without hiring new people. So it's not surprising that they're going to slow down hiring. And also that's going to enable them potentially to protect their margins. They're in a part of the economy, though, that has strong secular growth. We know the cloud infrastructure has to be built up further in order to handle all the business around the world. So that's one of the reasons why we like them as long-term investments. And we think they're going to be more resilient than a lot of other names out there. So, yeah, I would expect them to talk about the slowing in hiring, but also to reinforce the view that they're still expanding in terms of their capacity to serve their customers and build out the big data centers that cloud computing really needs right now.
Joanne, how much cyclicality do you think is in a name like Amazon? When you made that description just then of why you're in those names, I heard Microsoft. I wasn't hearing Amazon. What is it about Amazon?
Yeah, sure. I mean, Amazon obviously also has a retail side of the business, but a lot of that has been discounted. A lot of folks have already built into their numbers a pretty steep drop on the retail side. And so some folks are even saying that the value on the retail side is almost de minimis right now in terms of how the stock is trading. And when you look at the growth potential on the cloud side of the business, that really does justify a pretty steep increase in the multiple on Amazon, I believe, over the next, couple of years. So I think a lot of the risks to the retail side of Amazon have been priced in to a question you were asking earlier. And I think if they continue to deliver on the cloud side, I think the stock will be, and investors will be rewarded, even potentially in the short term for that.
Amazon on Thursday, alongside Apple after the close. I believe we get Facebook on Wednesday. A little bit later, we get Alphabet and Microsoft. Going to come to you, Clinton, just on the big tech players. What you're looking for from those names after the close today, tomorrow, and on Thursday?
I think we have to remember how impactful the tech community and industry and sector were to help us get through the pandemic. And their earnings, their stock price, those invested in those companies have all benefited from those. I know a lot of folks on our investor desk in Dallas towards the middle of last year started cutting back that exposure because those names have run up so much. So what I'm looking at now going through this week in tech earnings is it now time to lean back in? We all know the secular growth story. We all know cybersecurity. We all know data centers. We all know how important tech has been to get us here. Now the question for me is now the right entry point, or should we wait a little bit longer to see what guidance we get from some of these C-suite executives?
Are you leaning one way or the other at the moment?
Right now, I'm cautiously waiting. I do like defensive sectors more at this point because I do think a recession is on the horizon. But the tech companies have pulled back so much that you got to take a look at it. But I'm not leaning in yet. But I'm guessing towards the end of this year, I will be.
Clinton, you're going to be sticking with us. Clinton Warren alongside Joanne Feeney. This market's so divided. Lisa Shallard of Morgan Stanley Wealth Management wrote this in the last 24 hours. A modest uptick in unemployment claims from historically low levels is unlikely to end their mission, the Fed, if inflation remains well above their 2% target. The latest bear market rally, in our view, is full of wishful thinking. Lisa Shallard concluded by saying profit forecasts still need to be reset. We're resetting some of those profit forecasts right now. Let's get you some movers going into the open. Back with us is Kaylee.
Well, the big profit forecast being reset again for a second time is, of course, Walmart. John, that stock absolutely cratering in early hours, down about 9%, which would make the worst day for the stock since its previous guidance cut back in May. And, of course, it's taking other retailers down with it, including Shopify, which already was lower on the day. That move has now been accelerated on news that they're laying off 10% of their workforce, roughly 1,000 people, most of them in recruiting, support, and sales. The CEO saying in a memo, ultimately placing this bet was my call, and I got it wrong. The stock down 13% as a result. The more positive stories out there, though, in regard to earnings, some of them from 3M. That stock is up about 5% after saying it will split off its healthcare unit. So that's overshadowing the fact that the sales forecast was a little light due to the stronger dollar and macro uncertainty. And finally, GE is higher as well. Profit came in double what analysts were expecting. Positive free cash flow surprise as well. It's aerospace really providing the big boost. Those orders up 26%. So the stock getting a little bit of a lift before the bell, John.
Kelly, thank you. Coming up, the exciting stuff, debating definitions, a technical recession, why it isn't a real recession.
I don't think we're going to, God willing, I don't think we're going to see a recession.
That conversation up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Everyone's looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
This is not an economy that's in recession.
Because of the strength of our labor market recovery, because household balance sheets remain historically in a strong position.
My hope is we go from this rapid growth to steady growth.
I think it is fair to say that the United States is better positioned than virtually any other country to go at this challenge.
The Fed is charged with putting in place policies that will bring inflation down. And I expect them to be successful.
I don't think we're going to, God willing, I don't think we're going to see a recession.
GDP is out on Thursday, and the administration is preparing you that if we do get a negative print, it is not a recession. Joining us now, AMH down in DC, Mike McKee right next to me. Anne-Marie, I've heard it a couple of times in the last 24 hours. If you're explaining, you're losing.
Yeah, it's true. And John, this is really the semantics of it, and they're trying to get ahead of it because they are worried about this potential negative print. And then the headlines will say the U.S. is in a recession, a technical recession. But what the administration wants you to know beforehand is that a technical recession doesn't technically mean a recession. They are going off the definition from the National Bureau of Economic Research, and they're talking about the fact that if there was a recession, it would need to be broad-based. It is more complex than just back-to-back quarters of negative growth. Now, maybe a lot of people can see that nuance and understand it, but the issue they have is that if there is back-to-back negative growth, there is this issue that the data could sour and there could in the future be a recession. So they are obviously doing a lot of dancing around what the definition is, but there are potentially some alarm bells down the road. And you could see that today with, consumer sentiment and what's going on at the likes of Walmart.
I can tell you this is driving Mike McKee nuts. How nuts are you feeling right now, Mike?
I live here.
Well, I suppose that I'm not feeling quite as nuts as AMH because she's got to deal with the political perceptions around the country. I only have to deal with economists and people on Wall Street. And at this point, the political perceptions are going to be the hardest ones to sell. As she was saying, you look at what's happened in the past and the 2 quarters of contraction thing, it's going to be pretty easy for Republicans to make this case because we've never had a recession that did not, we've never had 2 quarters of consecutive growth, contraction that was not in recession. We have had, however, recessions without 2 quarters of contracting growth. So it's hard to say that this technical recession may not be a recession in people's minds. You can expect the Fed to talk about it tomorrow. Obviously, they're going to raise rates by 75 basis points and give only vague forward guidance because they don't want to be pinned down given the uncertainties in the economy. How do they assess inflation and growth? That's going to be kind of the key question. But will anybody pay attention out there in political land? The problem is the Fed is going to be committed to bringing down inflation no matter what. They learned their lessons from the early 70s when Paul Volcker was there, and he raised rates significantly, and then they cut rates a lot, and inflation came down, but not very much. So they had to raise rates again. They don't want to go through that up and down anymore. So expect the Fed to be slow to cut rates, which is going to feed into the political problems the administration has.
Mike McKee, thank you, buddy. To Anne-Marie, thank you to you as well. We'll catch up with you, no doubt, through the day tomorrow and on Thursday when we get the GDP print. This comes down to depth, duration, diffusion. Depth, duration, diffusion. The last word's the point we're going to be debating. How widespread is the weakness, if there is any weakness, if we do indeed get a negative print? Joanne Feeney, I want to come to you on that. Don't want to wait for the NBER to make a decision about anything. As a market participant, I don't think anyone's going to be interested in that. This is about whether we see signs of weakness now and whether that weakness is starting to spread week after week, month after month. Do you see that?
Yeah, John, that's exactly the question. When people use the term recession, I think what they mean is, is this slowdown going to become severe and is it going to last a long time? And right now, the data don't indicate that's where we are, although things could change. The negative GDP print in the first quarter was largely because imports were so strong and because inventories were drawn down. Both of those were signals of strong demand in the U.S. from consumers. This quarter just passed could see some more of that. So it's really not showing up broader that we're seeing a slowdown in production. We're not seeing yet the slowdown at an aggregate level in hiring. These are the things that we're going to look to earnings guidance to tell us about. Are companies starting to prepare for a slower, perhaps negative growth outlook? And some of them are. And I think that's why we have to be careful and recognize that this recession is still born of supply constraints out of the pandemic and its ongoing problems with people getting out sick from COVID and China's zero COVID policy. And on the other side, we still have resilient household balance sheets. Consumer demand is still pretty strong, except in the middle to lower end, where they're feeling the impact of that high energy and food inflation primarily.
Clinton, let me come to you on the same question. You said we might be in the eye of the storm right now. The consensus view is that if we do get a downturn, it'll be shallow and it won't last very long. Do you agree with that?
Yeah, I think we all just have to take a step back and remember, you're talking about duration, how long the expansionary period before the man-made forced recession was. I remember thinking and talking to my colleagues in 2019, thinking, hey, this is a long expansionary period. A recession should be imminent. Does the Fed have enough tools to get us out of it? And then we had this man-made recession, strong recovery, and here we are. So it just surprises me that a lot of us that are market participants forget about how long of an expansion period we were in and the position we are in now. And to your specific question, yeah, I think we will slide into a recession. I think the Fed is going to be forced to bring down an inflation at a little bit rapid, more pace than they want to. But I do think it's going to be shallow. I don't think it's going to be deep. And you also got to remember that the Fed has a dual mandate, right? The job side of the...
Hello, traders. If you're looking to trade euro, here's the time. I'm placing an order to buy euro for the price 101.38. Please place your order. Stay with me and we will close this trade together. I will adjust the order. Okay, order placed. You still have time to place your order and wait for, as soon as we will get filled, wait for my instruction and I'll let you know what I'm going to do next. Okay, if you want to get a strategy, you need to go to company.co.uk and you need to buy the strategy. Stay safe, guys.
Friend of this program, Deutsche Bank, Barclays, Credit Suisse, Nomura, Bank of America. Those banks, those teams are looking for a negative print this Thursday. It's just not the consensus view just yet. From New York, up next, the morning calls, and later, the pain in equity markets is only about halfway done. That's the view of Peter Cicchini of Exonic Capital. He does not think the lows in June are the lows of the year. That conversation coming up.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Walmart gave sentiment a smack in the face this morning, and the IMF just piled on. Equity futures down 0.5% on the S&P 500. We'll talk about the retailers in America in just a moment. The Nasdaq down about 0.6%. Need to talk about Europe too. Euro dollar deeply negative through much of this morning. You see it there. We're down 0.8%. A weaker euro story. It looks like the Kremlin might continue to squeeze Europe. That's our latest reporting, and you see that in the numbers. The capacity coming through Nord Stream 1, the capacity utilization has gone from 40%. It's set to drop to 20%, and the Europeans are voluntarily pulling back on the use of Russian gas. All of that spells out weaker GDP in Europe, and that this morning means a weaker euro. That's the price action. Here are your morning calls. First up, Wolf Research downgrading Roku to underperform, pointing to a host of challenges, including ongoing supply chain disruptions. That stock is negative 5%. B of A downgrading American Eagle to underperform, expecting results to miss estimates amid weakening consumer trends. And finally, Goldman downgrading Paramount to sell from buy, seeing limited upside due to intensifying macro headwinds. That stock is down by 4.5%. Coming up, Walmart raising concerns about the damage from surging inflation. We'll get the view of Peter Shakidi of Exonic very, very shortly. Your opening bout, 4 minutes away.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Busy couple of days coming up from New York City this morning. Good morning. Going into the opening bell equity futures, just a little lighter, softer, lower, negative, 0.5% on the S&P. On the Nasdaq 100, we're down 0.6%. The small caps on the Russell doing okay, down 0.4% going into the opening bell. There's your opening bell. Switch on the board and get to the bond market. I'll bring you the opening price on Walmart in just a moment. Yields in 7 or 8 basis points. Walmart, the IMF, stuff with the Kremlin, European gas, take your pick. Pretty defensive and negative.
Okay, guys, if you managed to fill this order, well done. Good for you. We didn't have chance to fill the order. For time being, I'm going to cancel it. If you placed an order, please place your stop loss at 101.40. You will get 2 pips if it will move lower. In our case, we're going to wait until it will move lower, and then we will place order again. We need to see it looks like momentum trying to find the right direction. Okay, USA market just opened, so anything can happen. In your case, you're already in profit, so just place your order at 101.40. Okay, guys, I'll speak to you later.
UPS down almost 5%. Coinbase, too, also under pressure. That's after a Bloomberg News exclusive that the crypto exchange faces an SEC investigation as to whether it offered unregistered securities to trade. That's typically a bad thing. Coinbase down over 8%. And John, let's end with a gainer. You do have Archer Daniels Midland. It posted records profits. That was thanks to tight grain supplies, of course, due to the Ukraine war. But that stock up about 4% or so.
Katie, thank you. If the SEC comes knocking, it's typically not a good thing, as you know. I like that. Equities right now, about a minute and 20 seconds into it. There's only one stock to watch. It's Walmart. It's down 8%. We're all asking who's next. Looks very much like what we heard from Target recently. Let's get you some more. Here's Kelly Lights.
Well, it may be the clothing and apparel retailers that are next, John, because Walmart in its release warned specifically about that, saying that while customers are spending more on food and fuel, that means general merchandise is taking a hit. And the quote from the release exactly is apparel in Walmart US is requiring more markdown dollars, trying to cut prices to work down the inventory. And that doesn't have a great read through to a lot of those apparel-oriented stocks, the like of Macy's, Kohl's, Gap, TJX. They're all down in the ballpark of 6% or so this morning. And that's really the thing, John, is that when you're talking about a consumer specifically at the lower end that has a higher grocery bill with food prices up about 15% this year and a higher gas bill, because yes, even though prices at the pump have come down since mid-June, they're still up about 30% on the year, and electricity bills have gone up as well. So that is all necessities. That is things that you have to spend money on even in the face of inflation. What does that mean you'll likely cut back on? Discretionary goods. And we can see that reflected in the price action for the consumer discretionary sector. It is down about 27% year to date, underperforming staples by a wider margin, though it's down as well. Actually, discretionary, the second worst performer in the S&P 500 on a sector basis this year. And that is a story that is just getting worse after Walmart this morning, John.
Kelly, thank you. We've had hint after hint, signal after signal that this is what is taking place. Bank of America put the credit spending data out, the card spending data in the last couple of months. Low-income workers in America spending almost 10% of their monthly income on gas. We knew the squeeze was happening. As we said a little bit earlier in the program, surprised that this market is surprised by this and surprised that the likes of Walmart and Target have to keep coming out and doing this. Stock is down by about 8%. Who's next? Morgan Stanley raised the risk around Amazon. They say this: we believe Walmart's profit guide down and expectation for increased markdowns raises the risk around Amazon's merchandise margins. Let's get to the West Coast and catch up with Ed Ludlow. Morning, Ed.
Yeah, good morning, John. Amazon, one of the worst performing stocks on the NASDAQ 100 this morning. We're down more than 4.4%. The street's kind of split, though. There's two schools of thought. The one school of thought is that there is clearly some symmetry in the operational risk and headwinds that Amazon faces relative to what Walmart disclosed late last night. The other side of the story is that actually Amazon serves a different customer base, a different section of the economy that is less stressed in having to choose between discretionary and essential items. A lot of movement in this space this morning. Just a quick mention of Shopify, which says that it will cut headcount by 10% by the end of today, citing similar pressures. There's also the Amazon Prime Day effect. Remember, Amazon Prime Day was only 10 days ago, right at the start of the third quarter. There is a feeling then that later this week, when Amazon reports second quarter earnings, that sales may have been impacted because the savvy Prime Day shopper was waiting for that event rather than spending in the second quarter. That's that insulation that I was talking about, particularly Bloomberg Intelligence beating this drum, saying that actually you have higher income client base that shops on Amazon Prime. They won't be as worried about what we're seeing, but that pull forward or pull push back effect from Prime Day is really interesting. John, I'm not sure what you bought last couple of weeks, but Prime Day was a really nice shopping event for me and it was well worth the wait.
Thank you, Ed. Thanks for sharing that personal story. What else did you buy? Do you want to tell me, since you seem so excited about that moment?
I'm a tech guy. I bought some gadgets for my phones and I bought some new trash bags for my bins. It was great.
Thanks for sharing, buddy. Can I get a headline in? Some actual news from Elon Musk. Can you comment on this one, Ed? Elon Musk's lawyers say Twitter is resisting producing documents. His lawyers would like an October 17th to 21st Twitter trial date. They say Twitter is insisting on an October 10th trial date. How important is this, Ed?
Yeah, important. I mean, remember that originally the Musk camp was pushing for a February 2023 date. The Twitter camp were pushing for a September date. The judge said, you can do October, and between the two of you, I want you to go away and sort out which one. The Musk's camp argue that they need every day they can get to pass over a large volume of data, which Twitter either is or is not putting forward. They're kind of contradicting themselves, because Musk is saying on the one hand, you're not giving us what we want in terms of being able to evaluate the level of bots on the platform. They're also arguing they don't have enough time to assess what they are being given. And Twitter's argument in the middle is, we've given you everything that's available, and much of what you're asking for, private or third-party data, doesn't exist and is not possible to evaluate the level of bots on the platform through a third party anyway. So we seem to be moving towards a middle ground, but this was expected because the judge told the two parties to sort them out amongst themselves.
Ed, thanks a lot, mate. We'll catch up with you soon on that story and your shopping another time. Ed Ludlow on the West Coast. And more stories than one. Here's one for you. Shopify. Just trouble in retail and e-commerce. Shopify down and down hard. You saw their plans to cut staff. Never headlines you want to see, really. This from Walmart, obviously. They're down and down hard after cutting their profit outlook. Earnings from them were meant to come in the middle of August alongside Target. You wonder if we'll hear from Target before we get those earnings too. Exotic's Peter Giacchini has this to say. While positioning as softer economic data might support a bear market bounce through summer, the valuation adjustment for equities is perhaps only about halfway complete. Even an unlikely dovish Fed pivot can't do much now to prevent a recession. Pete, I'm pleased to say, joins us now. Pete, let's start there. Why can't a Fed pivot right now do much to prevent a recession?
Well, good morning, John. Great to be on again. The adjustment to equity valuations occurred first and foremost through PEs as a function of the Fed pivoting towards what it finally admitted was non-transitory inflation. And that adjustment has, I think, been made for the most part. Rates vol, in fact, has come in a little bit if we look at the MOVE index. And fortunately, for example, the 10-year yield is now closer to 270 than 350. The next leg, though, is the other impact that inflation has on the real economy. So the first transmission mechanism is through capital costs and PEs, lower PEs. And the second mechanism is through margins. And we're just now seeing that. And in fact, we're now seeing companies react to that, which means that inflation will likely remain a bit sticky because the consumer has yet to see price increases by companies like Kimberly-Clark and the like. So that's the second leg, in my view, that equities, that the second catalyst, in my view, that will drive equities lower.
Pete, is that a broad-based equity story or concentrated in a particular industry?
Yeah, clearly this is an environment in which, stock selection becomes more important. And in fact, asset class selection becomes more important. As you know, at Exonic, we are focused on credit and structured products. And we still think there are areas of structured products in multifamily, for example, that provide great value. And our opportunity set is doing nothing but growing, while equities, we think, provides a very poor opportunity set in this environment. Within equities, I would say that clearly energy, still think, even though it's corrected recently, is an interesting place to be. You called out natural gas earlier in the program. Oil prices are, we think, not going to go much below $100 given the geopolitical situation in Russia and the Ukraine. So we still generally like energy. I would stay away from consumer discretionary. What we're seeing with Walmart is likely to persist for a while across that group.
Pete, just how unusual would it be to have energy names perform well and outperform, relatively speaking, in a recession?
Yeah, look, it would be unusual because eventually what happens, right, is that the consumer just taps out eventually and travels less, and that demand elasticity affects energy names just as it affects the rest of the market, right? And that's when correlation picks up. I don't think we're quite there yet, and in that note, I mentioned that we could see a bit of a bounce through the summer simply because 10-year yields have come in, and that part of the de-risking in equities, I think, is complete. That said, again, margins and earnings are the next shoe to drop for equities. But I agree with you. Energy is not a forever trade in a recessionary environment, and so one needs to stay nimble and exit that trade before that next shoe drops.
People itching to get into the so-called defensiveness, resilience of some of these big tech names which just spit out cash every single quarter. Pete, this time around, are we underestimating the cyclicality, just pockets of cyclicality in some of these big tech names? Can they deliver that resilience, that defensiveness in a lower growth world?
Yeah, well, I think there are two things to consider. Number one, the valuations coming into this correction were quite high, excessively high. And that was, look, that was partly a function of the fact that people were buying these stocks and flows into big tech were considered defensive, especially when $6 trillion of stimulus was filling people's bank accounts. That tailwind, if you will, has waned. And in fact, one of the things that I continue to try to correct is this idea that there's $2.5 trillion of excess savings in the system. If you look at personal savings, and you can do that on the Bloomberg terminal, we can see that it fell to $800 billion and is now back to $1 trillion because of tax reimbursements. But that was $6 trillion, and a lot of that was going into big tech on this, this story that the way people work was going to change forever. And I think we're seeing now that that narrative is changing. And many narratives have changed, right? There was no leverage in the Bitcoin ecosystem. Well, that ends up not being true. So I think a lot of the narratives around big tech and emerging tech have now proven false.
Pete, have you ever heard of Apple cutting prices on top-tier iPhones? Pete, what did you make of that?
That does not mean they haven't, but I certainly have not. And I do think, John, that is telling, and that's clearly why you bring it up.
Does that speak to weakness in China or weakness for the whole company?
Well, this is interesting. I obviously don't know the answer to that question. However, one of the things that happens in an inflationary environment is that eventually it tilts to a disinflationary and perhaps even a deflationary environment through the demand elasticity function, right? If prices go up enough, people just stop buying and volumes fall, and that leads to companies eventually moving from price hikers to price cutters. I don't know if that's what's happening here or if this is something idiosyncratic to the geographic mix at Apple, but I would suspect that's part of what's happening because that is, to my mind, a luxury item. But that's coming from a guy who has a Samsung, so maybe I don't count.
That's certainly happening with general merchandise anyway, and you can see that in Walmart. They're telling us that. Peter, great to catch up. Peter Giacchini, awesome as always. Walmart down about 7.9% in early trading. The broader equity market lower too. On the S&P 500, we're down by about 5 or 6/10 of 1%. The Nasdaq underperforming. That's down 1%, negative 1% on the Nasdaq. Going into these earnings a little bit later. I'll repeat them again. Alphabet and Microsoft after the bell later. Tomorrow, Facebook, still can't call it Meta. Then on Thursday, Apple and Amazon. Coming up, Speaker Pelosi's potential Taiwan visit, stoking US-China tensions.
The administration routinely provides members of Congress with information and context for potential travel, including geopolitical and security considerations. Members of Congress will make their own decisions.
That conversation up next.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
If the Pelosi trip will go ahead. I don't know if there'll be a crisis now, but I think it's a question of when and not if the United States and China are going to find themselves in a crisis at which Taiwan is at the center of it. There's a whole set of policies that we are not where we need to be, and we had better get there in a hurry, because China's timetable may be accelerated in ways we hadn't anticipated.
Speaker Pelosi's potential trip to Taiwan adding to US-China tensions. China's foreign ministry spokesperson saying the government will, quote, take firm and strong measures to safeguard our sovereignty and territorial integrity. Back with us down in D.C. is Anne-Marie. Anne-Marie, this one getting just a little bit more tense day after day.
Yeah, we should note, though, Jonathan, that a person close to these travel plans has said there's been no final decision yet on whether Speaker Pelosi will go to Taiwan or not. She is scheduled to do this Asia trip in August, but depending not yet, we don't know if she's going to make that trip to Taiwan. The president was pretty emphatic about it and direct when he had said to reporters that the military is advising that now would not be a good time to go. And it also comes at a time when the president told us just yesterday that he is expecting to speak with President Xi in just a few days. So what you have here is this potential trip, and what's going on in China is that President Xi and the foreign minister coming out and saying they are strongly going to prepare for this. They do not want Speaker Pelosi to come to Taiwan. This would be the first time in 25 years. The last sitting Speaker of the House was Newt Gingrich in the late 90s that went to Taiwan. But we're looking at this through a very American phase. We should also note there's a lot of troubles at home for Xi. All politics is domestic. He is about to cement an unprecedented third term this fall, and he has a slew of issues facing him. COVID-zero policy, youth unemployment, an economy that is struggling given all of what is going on with their serious COVID lockdowns. So this could potentially be the Chinese deflecting, but it is a risk on both sides.
It wouldn't be the first time. Anne-Marie, if we had any indication whatsoever that this president in Washington, President Joe Biden, is willing to remove tariffs on Chinese goods?
We don't know yet. We ask every day. We still do not know. They have been debating this now for what feels like almost a year. And the administration, this has really come into the forefront over the past few months, of course, with inflation at a 40-year high, because they said they will do anything possible in their toolbox to tackle inflation. Some economists say remove some of those tariffs. That could potentially ease some of these price pressures. But at the same time, individuals in the administration from the national security perspective, those from the trade delegation say this loses our leverage and we should not be giving an inch to China. Also, Jonathan, it will be a major talking point for Republicans ahead of the midterm election. So there's a lot to weigh there on whether or not they want to remove some of those tariffs.
Anne-Marie, this is tough to answer, but what do you think is guiding that decision? Is it foreign policy concerns, or is it the direction of gas domestically? Because looking at gas, it's been moving in the right direction every single day since the middle of June.
Potentially, with the ease up in gas prices, now you have it below $4.50. This has become one of these hallmarks now of the president's economic agenda. He tweets about it all the time, kind of similar to the way the former president used to look at the S&P 500 as the direction of the economy. Maybe the easing up, it's a great question, the easing up of gas prices gives them a little bit more leverage to maybe not have to move on the tariffs. But there definitely is, I would say, strong arguments within the administration on both sides on whether or not to remove some of those tariffs. It's something China wants to see, though. So potentially they can ask for something else in return. It'll be a very interesting meeting, and I hope we get a solid readout from the administration when he speaks to Xi Jinping.
Fingers crossed. Anne-Marie, thank you. AMH down in DC. One name I wanted to talk about just briefly, Alibaba. Wanted to cross over to Kaylee Lights for that. Hey, Kaylee.
Hey, yeah, John, those ADRs here in the U.S. up about 2%, but that follows a move higher of more than 5% in the Asian session overnight. The news there is they are looking to seek a primary listing in Hong Kong. That essentially could free up flows from Chinese buyers to be able to buy the stock directly for the first time. And of course, that news is also giving a lift to some of these other Chinese technology stocks listed in the U.S. because, John, we know they are facing an issue with auditing. It has been another point of contention between the U.S. and China. The rules of Chinese firms listed here, the disclosures that they provide, there's been a lot of back and forth, so there is a very real risk that they have to delist from the U.S. So Alibaba clearly trying to more firmly entrench itself in markets in Asia, given that risk that is out there, and that's seen as a positive thing for the stock today.
Kaylee, awesome. As always, Kaylee Lights there on the latest on some of those ADRs. Alibaba in particular. Wanted to bring you a note from Wells Fargo with that note of caution around Apple, just to fold the China story into them off the back of that conversation I had with Peter Cicchini. Overall, we see a worsening COVID situation in China and beyond, a deteriorating macro environment and increasing FX impacts as the biggest risk to near-term estimates. That note out in the last week or so, and it's just something that's stuck with me going into earnings on Thursday. Looking forward to the tech results, of course. On Thursday, we'll have Amazon and Apple as well. And before that, we've got a Fed decision. Coming up, I'll bring you the trading diary from New York. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
25 minutes into the session, your equity market pulls back, down 0.6% on the S&P. On the Nasdaq, we're down about 1%. You know the big tech earnings story a little bit later after the close. We'll hear from Alphabet. We'll hear from Microsoft as well. One story I wanted to talk about briefly is just the euro dollar, deeply negative and down about 0.8%. Clearly, the Kremlin putting on the squeeze a little bit. Our reporting suggesting we're going to get more of that, and the Europeans need to cut gas consumption. We're going to have a tricky couple of months in Europe. We all know that. And the European currency, the single currency, taking it on the chin right now at 101.34. That's the price action. Here's the trading diary. What you need to be watching: President Biden meeting with the chairman and principal owner of the SK Group at 2 p.m. Big tech earnings kicking off with Alphabet and Microsoft after the close. The Fed rate decision and Chairman Powell news conference Wednesday. US GDP and jobless claims on Thursday, followed by earnings from Apple and Amazon. We round out the week on Friday with PCE, UMich Consumer Sentiment Survey, and a ton of data on both sides of the Atlantic too. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound.
Okay.
And that crack is a sonic boom.
Yeah.
I think the way they got a date was to impress the females by making loud booms.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners. and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.